Let's start a new chapter. And what is that chapter? Capital gain. So somebody was asking, when will I start capital gains? So yes, now I'm about to start capital gains. So listen. So you tell me, under capital gains, when will a transaction be taxable under capital gains? For attracting taxation under capital gains, there are certain conditions that require to be satisfied. First of all, there should be a capital asset, plus there should be transfer. If you are transferring a capital asset, then the capital gain or losses, whatever you are incurring, shall be taxable normally in the year of transfer. Say for example, whenever you are selling a capital asset, you have to compute the capital gain in the year of sale. Are you with me? Are you with me? So whenever you are computing capital gain, you have to compute the capital gains in the year of sale. Now you tell me, how many types of capital assets you have or we have? How many types of capital assets we have? Two types of capital assets we have. Which all are the two types of capital assets? We have long-term capital asset. That is called as where period of holding more than 12 months. We will call an asset as long-term capital asset. What is period of holding? That means the period between date of purchase and date of sale is said to be period of holding. If period of holding of a particular asset is more than 12 months, then, sorry, not 12, I've said 12, right? Sorry, 36 months. That is a general theory. For certain assets, it is 12. For certain assets, it is 12. Like listed share, it is 12 months. But most probably, 36 is the general theory. Okay, more than 36 months, it will be long-term capital asset. And if the period of holding, is less than or equal to 36 months, it shall be short-term capital assets. Are you with me? Are you with me? But for certain assets, when we discuss capital gains, for certain assets, the period of holding criteria is 12 months. For certain other assets, the period of holding criteria is 24 months. Let's take the example of 12 months assets, important assets that comes under the 12 months category, that is listed shares. Whenever you are computing the capital gain of a listed share, then the period of holding will become long-term capital gain. Sorry, the capital asset or the gain will become long-term capital gain if period of holding is more than 12 months. It's not 36, it is 12 for listed share. Then you can say UTI units. It is whether listed or unlisted. Listed or unlisted, the period of holding always have to be 12 months. And for certain assets, it is 24 months. Which all are the assets comes under 24 months category? Unlisted shares and immovable properties. Like land, building, etc. When you are transferring, the period of holding criteria have to be 24 months. Are you all with me? Are you all with me? So these are actually the basics. So period of holding shall be 24 months for unlisted share, immovable property. Then period of holding have to be 12 months for listed share or UTI units. And can you give me an example for an asset where period of holding criteria is 36 months? Can you give me an example where period of holding criteria is 36 months? Immovable property means land or building. Okay, so land and building will not come. No, not land and building. That is immovable property. Gold, jewelry, archaeological collections, paintings, drawings, etc. Other assets will come under 36 months category. Are you with me? Are you with me? So other assets will come under 36 months criteria. So first of all, now the next thing that you should know, how do you compute capital gain? Say how to compute long-term capital gain and how to compute short-term capital gain. Tell me, what is the methodology for computing long and short capital gain? First of all, you require full value consideration. Full value consideration. That is the gross transfer value. From that you can deduct direct expenses. You can deduct what? Direct expenses like brokerage, commission, etc. Then you will get what? Net sale consideration. From the net sale consideration you have to deduct what? Cost of acquisition, that is indexed cost of acquisition as well as indexed cost of improvement. You have to deduct what? Indexed cost of acquisition and indexed cost of improvement. You will get long-term capital gain. What is indexed cost of acquisition? That is this budget. Okay, think about the things that you have to study. You have to complete inter. Then we will think about the budgetary amendments. Okay. Now, listen. Indexed cost of acquisition. What do you mean by indexed cost of acquisition? Say for example, I purchased a property, say in 2001. I purchased a property in 2001 for 1 lakh. 1-2 period I purchased a property for what value? 1 lakh. Are you all with me? And I'm selling that particular property. For 80 lakhs right now. I'm selling that particular property for what value? 80 lakhs right now. You tell me, when you compute the capital gain, your full value consideration will be 80 lakh. You cannot take cost of acquisition at 1 lakh. Why? The value of 1 lakh in 2001-2 is very high compared to the value in 2023-24 due to the inflation factor. Are you with me? So you have to take that 1 lakh and you have to inflate the value in accordance with the inflation indexes notified by the central government. Are you with me? Are you with me? You have to take that 1 lakh rupees and you have to inflate the value in accordance with the inflation indexes notified by the central government. And what are the inflation indexes? For that, there is a table called as index table. It is given in your book, okay? This is called as index table and this will be there in your examination. Either the entire table or the required index numbers will be provided in examination. So you don't have to by heart the index numbers. You tell me, what is the index number for the year 2001-2002? What is the index number for 2001-2002? 100. What is the index number for 2023-24, year of sale? 348. So I've sold that particular asset in 2023-24. So it is 348. Now how do you inflate that 1 lakh? You take that 1 lakh, multiply it by the index number in the year of transfer, divided by the index number in the year of purchase. Now can you tell me how much will be your index cost of acquisition? 3,48,000 will be your index cost of acquisition. You have to deduct the 3,48,000 from 80 lakh and you will get the long-term capital gain. Can you tell me how much is the long-term capital gain? 76,52,000. This is how you have to compute the long-term capital gain. And if there is improvement expenditure, you can deduct that also. You can index that also. What is improvement? Cost of acquisition means purchase price. What is improvement? Any additional expenditure that increases the value of asset. Example, a land, constructing a fencing will be an improvement expenditure. Say for a building, constructing another floor will be an improvement expenditure. Are you with me? So for a jewelry, you putting a stone, a valuable stone in that particular jewelry will be an improvement expenditure. Exactly. Putting a diamond on a gold ring will be an improvement expenditure. So indexation is applied on both the cost of acquisition as well as on the cost of improvement. You can apply the indexation both on the cost of acquisition as well as the cost of improvement. Are you all with me? Are you all with me? Now friends, now there is another interesting thing. These are the basics, okay? We'll finish up the basics, then we will move on to the advanced topics and the capital gain, okay? So there is one more thing. Index number is actually starting from which year? 2001, 2002 only. Index numbers are getting started from 2001, 2002 only. You tell me, what if you are purchasing an asset before 1st April 2001? Let's see. If you are purchasing an asset before 1st April 2001, what to do? That's what we are about to discuss. Are you all with me? So these are actually basics. That's why I'm keep on jumping from one page to another, okay? Let's complete the basics, then you will get an overall idea when I say the other provision. Are you with me? The revision book has been prepared on the basis of section order. Okay, revision book actually based on our summary handbook. This summary handbook is actually prepared on the section order. So here also I follow the section numbers, section orders. That's why one thing is in one page and other thing is other page. But when you study this, you should understand the basics. Are you with me? Once I'll finish the basics, then we will follow the revision books order. Okay. So if you are purchasing an asset before 1st April 2001, then what to do? Let's see. Let's create an example. Let me create an example. Listen. I purchased an asset in 1990-91 period. 1990-91 period for say 1 lakh. This is the purchase cost. Then I sold this asset in 2023-24, say for 80 lakhs. Then, as you all know, we don't have a number, index number for 1991. So what to do? Department say, you find out the fair market value of the asset as on 1st April 2001. You find out what? The market value of that particular asset as on 1st April 2001. Say the market value is 10 lakh. Say the market value is how much? 10 lakh. Then what to do? While computing the capital gain, your full value consideration will be 80 lakh. While taking cost of acquisition, your original cost is 1 lakh. But department say either you take your original cost or you take the fair market value as on 1st April 2001, whichever is higher. Actually, Act says whichever is beneficial. Which is beneficial? Higher will be beneficial because it's your cost. Are you with me? So which one you will take in this case? 10 lakh. Then we can take 10 lakh and we can apply the index number, indexation from 2001 to 2023-24. Are you with me? That means 10 lakh into 348 divided by 100. It will be around 34 lakh 80,000 will be the cost of acquisition. Are you all here? You apply the fair market value or you take the fair market value as on 1st April 2001 as the cost of acquisition if you are actually purchasing an asset before 1st April 2001. Then you index it from 2001, 2002 till your year of transfer. Is that point clear? Is that point clear? But there is another thing. Say for example, for this asset, you are incurring an improvement expenditure. Improvement expenditure before 1st April 2001. You are incurring an improvement expenditure before 1st April 2001. You have to ignore it. Whether you are going with the original cost of acquisition or whether you are going with the fair market value as on 1st April 2001, all the improvement cost incurred in relation to an asset before 1st April 2001 have to be ignored while computing the capital gain. Are you with me? Are you with me? Again, that comes under the improvement. Okay. So cost of improvement, you can see cost of improvement incurred before 1st April 2001 always have to be ignored. Don't take any cost of improvement that is incurred before 1st April 2001. Now you tell me, can you take a cost of improvement which is incurred on or after 1st April 2001? Yes, that you can take. Before 1st April 2001, if you are incurring an improvement expenditure, you are not supposed to claim that as a deduction, irrespective of the fact that whether you are sticking on with the original cost of acquisition or whether you are sticking on with the FMV. Is that clear? Is that clear? Yes, superb. So this is how you compute the capital gain. Now there is another problem. Not problem, there is another thing here. Now imagine, yeah, that's what I'm saying. Okay, imagine, say it is a land or a building. Imagine it is a land or a building. Land or a building. Its original cost is how much? How much is the original cost in 1990-91? What is the original cost incurred by me? 1 lakh. Then I can take the fair market value as on 1st April 2001 as the cost of acquisition. Yes or no? But department say one thing. If stamp duty value as on 1st April 2001, if it is available, then the fair market value shall not exceed stamp duty value as on 1st April 2001. What is stamp duty value? What is stamp duty value? A value maintained by the stamp valuation authority to levy stamp duty charges at the time of purchase. Whenever you are purchasing a property, you have to pay the stamp duty charges. The value maintained by the stamp valuation authority for what? For collecting the stamp duty charges is said to be what? Stamp duty value. Because on 1st April 2001, this digitalization was not happening. So all the lands SDV is not available in India. So that's why they are using a word if available. That means if available in the question. Are you with me? For us, it is available in the question. So the point is, I'll create an example. You should tell me how to take the cost of acquisition. Say the original cost, 1 lakh. In 1991. FMV as on 1st April 2001, say 10 lakh. How much is FMV? 10 lakh. SDV as on 1st April 2001, say 12 lakh. Then you tell me, how do you take the cost of acquisition? Either 10 lakh or 1 lakh, whichever is higher. Normally it is fair market value or original cost, whichever is higher. Are you with me? Say this SDV instead of 12, say it is 9 lakh. This SDV instead of 12, it is 9 lakh. Then what department say? The fair market value as on 1st April 2001 shall never go beyond the SDV as on that date if it is available. So in this case, even though fair market value is 10, you can only take up to 9. 9 or 1, whichever is higher. Is that point clear? So repeat that again. The stamp duty value of a land, we are talking about only land and building. For other assets, stamp duty value is not available. Stamp duty value is available only for land and building. You have to pay the stamp duty charges only for purchasing land and building. Do you have to pay stamp duty charges for purchasing a gold ring? Do you have to pay? Which is a famous jeweler in Chennai? Come again? Kalyan Jewelers, I think it's Kerala Wala Jewelry, right? GRD. GRT. Okay. Is that the legend Saravanan? No. That is Saravana stores the supermarket, right? Everything you will get. Yeah, he is actually a famous guy right now, right? Acted in the movie. What was the movie name? Oh, that movie's name is Legend. Okay. Yeah. So that movie's name itself is Legend. I've saw some part of that movie. Oh, what an actor. He's a fantastic actor. Okay. Yeah. So, there is a funny thing. See, the driver Anna who normally, first time when I reached Chennai for this session, I think last week only I'm here because of the regular classes, okay. I was here and driver Anna was picking me up from the airport and I saw this Saravana Stores board. And then only I thought of this guy, that Legend. I simply asked the driver Anna, how is Legend here? Is he a fantastic guy or comedy piece? He said straight away, comedy piece, sir. He was not even thinking. Answer was ready. Spontaneously he said, the comedy pieces are. So anyways, I think, but he does the marketing in a brilliant way. Okay, he markets himself in a brilliant way. Even though it's a negative marketing, you guys are trolling him. That's actually marketing for him. Okay, now wherever he go, people recognize him. Okay, and one more thing is, sir, he haven't done anything wrong. He haven't done anything wrong. He only acted in a movie. That is the worst thing. Jokes apart. So coming back to the point, friends, listen. See, black goat in the group. What is that? Black sheep. That Rajini movie, Black Sheep. Okay. So, yeah. Where were we? All the black sheeps and white sheeps, listen. It is SDV. You cannot, your FMV shall not go beyond SDV. This is in the case of land or building. Are you all with me? This is not applicable for jewelry and all. That's why I asked about a jeweler, okay? And we actually went somewhere else. So coming back to the point, this is how you have to compute the cost of acquisition and cost of improvement as well as indexation. I'll give you a basic question for making it concrete, okay? So, it's just a basic question. You can quickly finish this off. Where is it? Yeah. Can you solve question number 7? Very easy question. Quickly go through this and give me the answer, okay? This is actually basics. So let me make sure that you understood the basics in a very well manner. All right. So let's solve the answer together, friends. So Mr. C purchases a house property for 1,06,000 on May 15th. Shh, keep quiet. May 15, 1975. The following expenses are incurred by him for making addition or alteration to the house property. So incurred certain expenses. Cost of construction of first floor is there, cost of construction of second floor is there, reconstruction of the property for 13-14 is there, fair market value as on 1st April 2001 is there, stamp duty value as on 1st April 2001 is there, house property sold by Mr. C for 68 lakh, expenses incurred on transfer 50,000, compute the capital gain for assessment year 24-25. You tell me where to start. Obviously, you start from the full value of consideration first. How much is the full value of consideration? 68 lakh. And how about direct expenses on transfer? 50,000. And how about the net sale consideration? 67 lakh, 50,000. How about the cost of acquisition? There is a problem. What is the problem? Original cost is in 1975, that is 1,06,000. So you can take either that original cost 1,06,000 or fair market value as on 1st April 2001. But that fair market value shall not go beyond stamp duty value if it is available. Stamp duty value is 875 and your fair market value is 8,50,000. You tell me which should be taken? 8,50,000 only, because fair market value is less only compared to the stamp duty value. So you can take that FMV itself. Now you tell me whichever is higher. Which is higher? 8,50,000. So you can take 8,50,000 as the cost of acquisition. And what is the index number in the year of transfer? 348. What is the index number in the 2001, 2002? 100. Can you tell me with the indexed cost of acquisition? 29 lakh, 58,000, round figure. Okay. How about cost of improvement? Let's talk about cost of improvement. Cost of improvement incurred before 1st April 2001, you have to ignore. So cost of construction of first floor is in 82, 83. Ignore. Cost of construction of second floor is in 2003, 2004. That you can take. That is 7,35,000. So cost of improvement 7,35,000 is there. And what is the index number in the year of transfer? 348. What is the index number in the year of acquisition? Acquisition not, improvement. 2003-4, that is 109. So you can take that 109. And can you tell me how much is the indexed cost of improvement? 23. $606. There is one more cost of improvement. What is that? They have reconstructed the property in 13-14 for 5,15,000. You can definitely claim that. So 5,15,000 into 348. What is the index number in 12-13? Oh, 5,50,000. Okay. 5,50,000. So what is the index number for 12-13? 220. Now can you help me with the indexed cost of improvement? 8 lakh? 70,000. 70,000 round figure. Okay. So you deduct these three and tell me how much is the taxable LTCG? 5 lakh? 75,000? 394 should be the taxable long-term capital gain. Is that clear? This is nothing. This is just a basic question. They will never ask this question in exam. Okay. If they ask this question in exam, these kinds of questions in exam, our pass percentage will be around 99.99%. Okay. So they will never ask. I've given this question to make sure that you understood the concept. Now, you have to compute this capital gain in which year, friends? In which PY? 23-24. In the PY in which transfer happened. Are you all with me? Now, listen. Where were we? Yeah, click a picture or whatever. If you don't have the answer, just click a picture or something. if you want. Already you got the answer maybe. Yes. Online also, should you consider expenses? I think you understood. Yes, expenses, yes. Sir, do one sum where vacant land on building or building with land, this type of scenario. What's the difference with if it is a vacant land or land with the building? Similarly, you have to take the cost. Okay. There is no difference whether if it's a vacant land or something. The treatment is same. Yeah. So listen friends, listen. We have we have completed the basics. Now let's move on in a chronological manner. So there are certain specialities in capital gain. We are about to discuss the special cases in capital gains. So we will start from now we will follow the order. Now you will understand if I follow the order. So now you will understand why I started from capital gain, basics, then I jumped to cost of acquisition, then I jumped to cost of improvement. Now you will understand. Okay, listen. Normally, as I've told you, capital gain will be taxable in the year of transfer. Whenever you transfer a capital asset, in that year of transfer, you have to compute the capital gain and pay the taxes. Are you all with me? Are you all with me? But for that theory, there are certain exceptions. For that theory, there are certain exceptions. One of the exceptions is section 45(1)(a). And let's understand what exactly is this 45(1)(a) is all about. Vacant land is there. On that, we construct a building. After we sold that, in this case, how to calculate? Vacant land will be the cost of acquisition. The construction cost will be the cost of improvement. Sales value will be the full value consideration. You compute accordingly. Yes. Now, where were we? 45(1)(a). That is receipts from insurance parties. Say, listen, very simple. You have a capital asset. What? You have a capital asset. That capital asset got destroyed. That capital asset got destroyed either due to flood, typhoon or hurricane. Flood, typhoon or hurricane. You know what is flood? You know what is hurricane? You know what is typhoon? And cyclone, earthquake or other convention of nature like tsunami, volcano eruption, whatever it is. Your asset got destroyed. Or due to riot or civil disturbance or accidental fire or explosion. Explosion happened and your asset got destroyed. Or because of action by enemy. What is action by enemy? Some terrorists came and attacked us and our asset got destroyed. Or action taken in combating the enemy. Our navy or our army actually shoot at the enemy, but ultimately that asset got destroyed. Okay, they had very good aim. So they shooted at the terrorist, but our asset got destroyed. Or the terrorist head, that bullet pierced his head and our asset got destroyed. Let's not, demoralize navy. All right, sorry, army. They correctly shooted, but the bullet pierced his head. Free fire. Then a game, okay. Free fire is a game, right? All right. So whatever it is, that asset got destroyed ultimately. Yes, war. War it is. So in these cases, if there is a destruction of your capital asset, you already had an insurance for that particular capital asset. You already had what? An insurance for that capital asset. Are you with me? If there is a destruction, your insurance company will definitely give you a compensation. Your insurance company will definitely give you a compensation. Then suddenly income tax department will come and say, we want treat. We want treat. What? Your asset got destroyed and you got compensation. It's a time to celebrate. Let's celebrate the destruction. Okay, you have to pay taxes for that. Why? Because if there is an asset and there is a destruction, that destruction is normally called as extinguishment of assets. It is also regarded as transfer. What is extinguishment? Your right over the asset came to an end due to destruction. And if you have an insurance compensation, if you are getting an insurance compensation, that compensation have to be treated as the full value consideration and you have to compute the capital gain accordingly. Are you with me? Are you with me? So we will read that chart again. If your asset is getting destroyed due to, read along with me, flood, typhoon, hurricane, cyclone, earthquake or other convention of nature, riot, civil disturbance, accidental fire, explosion, because of action by an enemy or action taken in combating the enemy, a person receives any money or other assets under insurance on account of the above, then gains, if any, are taxable in the PY in which such money or other assets was received or is received. You can cross off was is received. Such money or other asset is received, that year only you need to pay the taxes, even though year of destruction is the year of transfer. So it got destroyed today. You got insurance compensation next year. You have to compute the capital gain next year, not in the year of destruction. But the year of destruction is the year of transfer, because here transfer is extinguishment. That is the destruction. Are you with me? Have you with me? Now you will find a problem. How do we compute capital gain in such scenario? To solve that problem, I have given a computational format here. Okay, if you check the computational format, you will understand how to compute capital gain over here. Which value should be the full value consideration, you tell me? Either the cash or fair market value of asset received. In 99.99% cases, insurance company will pay you money. Money only. Okay, if they are giving you another asset, then you take the fair market value of asset. If they are giving you money, then the full value consideration have to be the money. What if they are giving both? They are giving an asset plus some money. Then you add it together. Fair market value of the asset received plus cash received. Are you with me? Are you with me? Now you tell me what is the direct expenses, what will be the direct expense? As usual, normal direct expenses you can claim. What about the cost of acquisition? Purchase price of the asset. It got destroyed due to earthquake. That doesn't make any difference in the cost of acquisition. That is the normal cost of purchase only. And in which year, how about indexation? Till the year of destruction. That means I purchased an asset in 2015-16. Are you all listening? It got destroyed today. That means in the year 2024-25. Next year I received what? Compensation. I have to compute capital gain only in the next year, but indexation I will get only till this year. Because indexation, that means year of transfer is the numerator of the indexation. Hope you remember. Numerator, you have to take the index number in the year of transfer. Denominator, you have to take the index number in the year of purchase. Even though you are computing the capital gain later, you will always get indexation only up to the year of destruction, not after that. Is that point clear? Then, how about the taxability in the year of receipt of compensation? How about the tax rate as applicable in the year of receipt of compensation? Is that point clear? Do you want me to give you a small question in relation to this? I'll give you a question because that's actually a fantastic question, okay? That's actually a fantastic question. Just go through this question and give me the answer, okay? Index numbers, make use of your revision material, okay? See, one thing, when you solve this question, one thing is there. That is the definition of capital asset, okay? Capital asset does not include movable personal effects. Capital asset does not include movable personal effects except jewelry, drawings, paintings, archaeological collections, sculptures and artwork. Are you all listening? In the definition, section 2, subsection 14, there is a definition for the word capital asset. Capital asset, what department say? Capital asset does not include movable personal effects. For example, I have a car which is used for my personal purpose. That is not capital asset. I have a furniture which is at my home. It is not a capital asset. But if the car is used for the business and capitalized in the books of accounts, then it is capital asset because it is not personal effect. If the furniture, if it is capitalized in the books of accounts and used for office purpose, that will become my capital asset. Are you with me? Are you with me? Yes, now one more thing. Movable personal effect means jewelry, gold also are movable personal effect, but there is an exception. Jewelry, drawings, paintings, archaeological collection, artwork and sculptures, even if it is movable personal effect, that have to be treated as your capital asset. These 6 items. I'll repeat. Jewelry, drawings, paintings, archaeological collections, sculptures and artwork. So let's compute it together. Shh. Lucky, shh, keep quiet and listen. Lucky has a house property acquired on 18/8/2009 for 6 lakh. He used the house for his own residential purpose. On 18/8/2012, he incurred a capital expenditure on reconstruction of the house. That is rupees 3 lakh. On 15/5/2018, he bought office goods, inflammable, worth 1 lakh at home to be delivered to a party staying near to his home. So he, on 2018, he bought some inflammable goods to his home to be delivered to some party which is staying nearby his home. At the night of that day, accidental fire took place and damaged the whole house property, furniture worth 5 lakh and business stock. So unfortunately at that day, a fire breakout came and completely destroyed his stock, house and furniture, and his name is Lucky. Maybe his parents might have foreseen that. That's why they called him Lucky. But don't laugh, he is lucky. Why? Because he had an insurance for the building, stock and furniture, and the insurance company given him claim. So insurance claim received on 18/8/2023. It took some time, but he received insurance claim on 18/8/2023. So you tell me, in which year you have to compute the capital gain? 23/24. That is year of receipt of insurance compensation. Are you with me? So we are computing everything in the PY 2023-24. Now, which all are the destroyed assets he have? House property. Second one, furniture. Then stock in trade. Out of this, house property is a capital asset. House property is a capital asset because it is not a movable personal effect. It is immovable. Your house property, can you move it? Doubt, huh? Today when you go home, you try pushing it, okay? Go home and try pushing it, okay? House property is a immovable asset, so it is definitely a capital asset. Then furniture at home, it is movable personal effect. So not capital asset. Stock in trade, not capital asset because it is covered under PGBP. Under PGBP only. So we need to compute the capital gain of house property only. The loss or profit that you are getting in relation to furniture is not taxable. The loss or profit that you are getting in relation to stock in trade will be taxable under PGBP. Are you with me? So in relation to house property, can you tell me how much is the full value consideration? How much is the compensation that you have received for house property? You received 1 lakh cash and fair market value of another property of 45. So altogether, how much is the total value? 44 lakh plus 1 lakh, that will be 45 lakh is the total value of consideration that you have received for the house. Are you with me? So it is 45 lakh is the full value consideration. Is there any direct expenses on transfer? They are not mentioning anything, so you don't have any direct expenses on transfer. So the net sale consideration will be same 45 lakhs. How about the cost of acquisition? Do you have a cost of acquisition? Of course. House property, there will be a cost of acquisition. So how much is the cost of acquisition? 6 lakh, that in the year 2009. So you can claim the benefit of indexation. But my question is, from which year to which year? You can claim indexation. From which year to which year? From 2009-10 to 2018-19. From where the hell this 18-19 came from? That is the year of destruction. So he took the inflammable goods on 15/5/2018. And that day, night of that day, an accidental fire took place. So that is the year of destruction. That is the 18-19. And what is the index number? In examination question, there will be index number, okay? They will definitely give you index number. Since I want to make this in one page, I skipped that index table, okay? What is the index number for 18-19? 280. What is the index number for 2009-10? 148. So we will make use of these index numbers and let's index the cost of acquisition. So cost of acquisition is 6 lakhs into, can you help me with the numbers? 280 by 148. So can you help me, how much will be the indexed cost of acquisition? 11,35,135. How about cost of improvement? He have constructed something over there, right? So he have constructed reconstruction of house 3 lakh. That is in 2012. Can you help me? What is the index number in 2012? 200 in 2012, right? 200 into 280. Can you help me? How much is the indexed cost of improvement? 4 lakh? 20,000? Down 20,000. Now how much will be the taxable LTCG? 29,000. 29 lakh? 44,865. Put separators, otherwise when you start your articleship, your principal will scold you left and right. He have given you a figure, you don't know whether it is crores, lakhs or thousand. In a meeting and all, you will start 0, tens, ones, lakh. If you be like that, your principal will definitely kill you, that's for sure. So always put separators. Once you put separators, when you see the figure itself, you will understand whether it is lakh, crore or whatever it is. Are you with me? Yes, good. So this is the long-term capital gain. And in furniture, what is the value of the furniture? Full answer. Yeah, I haven't completed it, Ali, don't worry, okay? I'll complete it and I'll show it to you. Definitely I'll show it to you, okay? Yes. So, what is the cost of furniture, friends? It worth, sorry, not that. Delivered to the house. Yeah, it is 5 lakh. The cost of furniture is 5 lakh. And how much you got from the insurance company? 2 lakh. So you have a loss of furniture. How much is that? 3 lakhs. So the cost of furniture is 5 lakh and the compensation, how much? 2 lakh. So how much is the loss? 3 lakh is the loss. What to do with this loss? Ignore. Because it is not a capital asset and you cannot claim that loss anywhere. If it is a profit also, you wouldn't have to pay taxes. But you will never get profit. Why? Because furniture, every year of usage, there will be a loss in the value. For car also it is like that. You use a car, every year the value will go down. That's why movable personal effect are not considered as capital asset, because if it is considered as capital asset, then you guys will come and ask for the loss. Yes or no? Yes or no? See, in capital gain, both the gain and loss will come. Don't consider it as a benefit. It is not at all beneficial. If they are saying all mobile assets as capital asset, then what will happen? The car that you sell, you will claim it as your loss. Department know that. Rarest of the rare case only, you will be able to sell car at profit. If you are selling, doing it in a second-hand sales or something, then that will be your business. Then that profit will be taxable under PGBP. You bought some car, second-hand car, and you sold it for a value which is more than the purchase value. That is very rare. No problem. Don't pay us tax. Because 99.99% cases it will be loss only. Okay? Yes. Sale of office car? Yes. Office car means capital asset, not personal effect. Okay? Yes. It's a depreciable asset. Section 50 will come into the picture. Hello, today morning only I taught you section 50. Yes or no? This is how you have to understand income tax. Whatever comes in left and right, you should give the answer. You should be able to give an answer. Are you with me? Use the revision note, okay? Use this revision note. This will definitely help you because I've included most of the things in this particular revision note. Are you all here? Yes. So, let's complete the answer. We have stock in trade. What is the cost of stock in trade? What was the cost of stock in trade? 1 lakh. And what is the amount that you got? 80,000. So how much is the loss? 20,000. So cost of stock in trade is 1 lakh. And the compensation that you got is 80,000. So the loss will be 20,000. What to do with this loss? It will be shown under PGBP. They are not asking for this, okay? But still I have computed it. That's it. Are you with me? Now they are asking one more thing. Tax treatment under capital gain? This is what they ask. So the official answer should be only this much. Okay, now, not yet over. How shall your answer differ if such compensation is received by assessee on 15/4/2024? What will be the change? Year of taxability will be PY 24/25. The answer is the same. There is no change in the indexation and all. Are you with me? And actually, central government have notified the latest index number for 24/25. It is 363. That is not record for you. Central government have notified the latest index number, that is 363. Okay, that is for 24/25. Your PY will be 23/24. So you don't have to know the 363 index number. Yeah. Can you please again explain how 45 lakhs? 44 lakh plus 1 will be 45 lakhs. Day, idu paru. 1 lakh is the cash. 44 lakh is the fair market value. 44 plus 1, 45. Got it? My net, don't cry da, it's okay. He's crying. Compensation given in cash, okay, good. Ali, you got the answer? I mean, you understood? 1 lakh into 280 by 200, what is that? Come again? It is 3 lakh, but the answer is wrong then. Oh, answer is right, it should be 3. Into 280 by 200, it will be 4 lakh 20. Okay. Yeah. Okay, thank you. Yes. All right. So let's move on with the next thing in under capital gains. Okay, there is a problem. 1 second, friends. I've accidentally closed that revision sheet. Sir, won't that loss of furniture be recorded anywhere? No. That's what I'm saying. Okay. You don't have to. Recorded means in your personal record you can write. Not to the income tax department. They don't want that. Should we simply ignore? Yes. Yes, Darshini. That is a personal loss. You are not supposed to show it anywhere. Yeah. So moving on, friends, we were discussing about 45 subsection 1A. Now let's understand what is 45 subsection 2. Can you read the heading 45 subsection 2? Conversion or treatment of capital asset as stock in trade. Or rather, sticking on to the theory, I'll take some problem oriented area. Okay. Since it is late evening, I'll take some problem. I'm not saying that I will leave you right now. Okay. Don't misunderstand me. These are theory, okay. Let it be there. We'll finish up some problem-oriented area so that I can give you some questions in between also. So let these things be here. Let's straight away go to the cost of acquisitions. There are certain interesting things under cost of acquisitions. We'll complete the cost of acquisitions right now. So listen. You should know the treatment of right shares. Okay, shh. Keep quiet and listen. What do you mean by right shares? What do you mean by right shares? We'll say treatment of right shares, okay. Theory is there in your revision handout. Theory is there in your revision handout. I'm about to, theory is there. What is the page number? You can take the page number 34. Theory is there in page number 34, okay. Now, let it be there. Let me use this particular chart to make you understand what is the treatment of right shares. You tell me what is right shares? What is right shares? Whenever a company is planning for a IPO or FPO, that means initial public offer of a further public offer, or whenever they are planning to issue more shares, the first thing that the company should do is what? Offer that shares to the existing shareholder for a price which is lesser than the market value. Offer that share to an existing shareholder for a price which is lesser than the market value. So we will take an example. Say the market value of a share is 1000 rupees. Okay, right price is say 600 rupees. What is right price? Existing shareholder is only supposed to pay 600 rupees to acquire that particular share. It is not issued at discount. Discount means less than par value or face value. That is not possible in Companies Act 2013. You cannot issue shares at discount. But you can issue shares at a value less than the market price. Are you with me? So the right price is only 600. This will be normally offered to an existing shareholder through a offer letter. We call it as offer letter. Technically it is known as right entitlement. You might have studied this in your law. Okay, whether you have studied it or not, I'm not taking any chances. I'm explaining it. Okay, this is actually law. So the company will offer this right share to the existing shareholder by way of issuing a right entitlement, or we can say offer letter. It's nowadays it is given by way of a mail. Okay, it is not a physical letter, it's by way of a mail. Now the existing shareholder have three options when he received that particular offer letter. What are the three options he have? Either accept it. Either accept it. Listen. Say first one, let's complete. Either he is accepting it. He accepted it and he sold that particular share after some time. He accepted that right shares and he sold that right shares after some time. Are you all listening? He accepted it and selling that right shares after some time. What will be his cost of acquisition for that right shares? He accepted that right share, then he sold that right share after 1 or 2 years. My question is, what will be the cost of acquisition of right shares when he subsequently sell that right shares? It is 600 rupees per share only. Why? Because he received that right share for 600 rupees. Are you with me? So this cost of acquisition on subsequent sale will be only the right price 600 rupees because he paid only 600 rupees. Are you with me? Now, say he rejected it. What is rejected? Not accepted. Then there is no capital gain impact. The company offered a right share and he said, I don't want it. Very simple. He rejected it. So there is no capital gain impact. And there is one more thing that is called as renouncing the right. What is that? Renounce. What is renouncing right? He took that right entitlement. He took that right entitlement and sold that right entitlement to another person. He took that right entitlement and he sold that right entitlement to another person. Say another person, say AP. What is AP? Another person. Okay. So AP bought that right entitlement for 100 rupees. AP bought that right entitlement for what value? 100 rupees. Right entitlement is also a capital asset. That right that he have is also should be considered as a capital asset. Now you tell me, when he sells that right entitlement, you have to compute the capital gain. When the existing shareholder sells that particular right entitlement, you have to compute what, friends? Capital gain. And you tell me, what is the full value consideration of that right entitlement according to the example? What is the full value consideration of right entitlement according to the example? 100 rupees. Why? Because he sold that right entitlement for 100 rupees. Are you with me? Now the interesting fact is, what is the cost of acquisition of right entitlement? 0. Because it is actually, you received it for free. You have to pay something for getting right entitlement. No. You have to pay 600 rupees for getting right share, not right entitlement, amma. Okay. Are you all with me? You have to study law also, okay. Then only you will be able to qualify CA Inter. This is actually law. Are you all with me? Sir, please once again. You're testing my patience, huh? See, right entitlement is also a capital asset. So whenever you are selling right entitlement, the sale price have to be treated as a full value consideration. The cost of acquisition of right entitlement will be always 0 because you are getting it. Why? Because you are an existing shareholder. You don't have to pay anything for getting that right entitlement. Are you with me? So the cost of acquisition is 0. And this capital gain will be always short-term capital gain. Why? Because the life of right entitlement will be for maximum 90 days. That right exercise will get expired within 90 days according to the company law. So practically for selling right entitlement, there won't be any long-term capital gain. Are you with me? This will be always STCG only. Are you with me? Now not yet over. Now this, another person, AP, he purchased right entitlement for what value? AP purchased the right entitlement for what value? 100 rupees. He have to pay another 600 rupees to get one right share. Yes or no? He paid 100 rupees for the right entitlement. Now he is supposed to pay another 600 rupees to the company for acquiring one right share. Now tell me, he got one right share from the company and he is selling that right share. He got one right share from the company and he is selling the right share. What about his cost of acquisition? It is 600 to the company plus 100 for the right entitlement. Altogether it will be 700. Are you with me? 600 he have to pay to the company for getting one right share and he already paid 100 for acquiring the right entitlement. So altogether for one right share his cost will be 700. Are you all with me? Is that point clear for you? So before this, let's complete the theory. Okay, the theory part. The theory part is very simple. Since to make you understand this, I have drawn the entire circumstance. So we are talking about cost of acquisitions. Cost of acquisitions. Because this comes under the cost of acquisition. Okay, ascertainment of cost of acquisition. Now can you read the first one? Right shares acquired by assessee. What will be the cost of acquisition? Cost of acquisition shall be the right price. When the existing shareholder himself accepts the right share and he sells it, the cost of acquisition will be the right price. In the case of a right renouncement, cost of acquisition of right entitlement shall be always 0. That means when the existing shareholder is renouncing the right, the cost of acquisition of that particular right entitlement will be 0. For the renouncee, who is renouncee? In our example, it is the AP. Renouncer means existing shareholder. Renouncee means the person who buys that right entitlement. For him, what will be the cost of acquisition? Right price plus amount paid to acquire the right entitlement. That means 600 plus 100, that will be 700. Is that point clear? Is that point clear? And I'll make you solve a question. I've selected one question here. It is there in your question sheet. Yes. Can you read question number 11 and give me the answer? It's a good question. Okay. All right, friends. So let's compute it together. Mr. R, listen. Mr. R holds 1,000 shares in Star Minus Limited, unlisted company, acquired in the year 1-2 at a cost of 75,000. He has been offered right shares by the company in the month of August 2023. So, offered right shares in August 2023. Okay. What is the right price? 160 per share. In the ratio of 2 for every 5 share held. So listen. How many number of shares Mr. R have? How many number of shares Mr. R have? 1,000. So friends, listen. Say you have learned a concept, but in examination you are not getting a grip over the question. Then what to do? You know that you have studied that concept, but you are not getting a grip over the question in examination. Then what to do? Skip the question and read the next question. Huh? What to do? Very simple. Note down the important facts and figures of that particular question. Not everything, okay? Only the important things. So Mr. R is there. How many shares he have? Original shares 1,000. You can say ORGSH, original shares. And which is the year of purchase? 2001-2. Then the company offered him right shares. How many right shares he got? 2 for every 5. That means 1,000 by 5 into 2. That is how much? He got 400 shares. Then what did he did? What? 50% rights he retained and renounces the balance 50% for 30 rupees per share. So the right price was 160 rupee per share. Out of this 400, we can divide that into 2. He accepted 200 shares. So for 200 shares at what cost? 160 per share. Are you with me? And he renounced 200 share right entitlement at 30 rupees. Are you with me? Who purchased this particular right entitlement? Mr. Q. She purchased, she or he, whatever it is. He or she purchased that particular right entitlement. It's Mr. Q, okay, not, then it is he. Purchased the right entitlement for what value? 30 rupees per share. And he have to go to the company and pay 160 rupees per share for the right shares. This is for the right entitlement and the other for the right shares. Then what happened? All the shares are sold by R for 300 per share in January 24, and Mr. C sold all the shares in December 23 at 280 per share. So both of them sold all the shares. When they are selling, sold all the share. In the case of R, it will be original right share, including right entitlement. Are you with me? So what you need to do in examination, if such a question they are asking, then Mr. R, you have to split how many type of assets he have? Original shares. Then right shares. Then you have right entitlement. You have to split that into 3. And what is the full value consideration of original shares? 300 into 1000, that will be 3 lakh. How about right shares? How many right shares? 200 right shares he sold into 300 rupees, and that will be 60,000. How many right entitlement is sold? 200 into 30 rupees per right entitlement, that will be 6,000. They are not mentioning anything about direct expenses, so I am straight away writing cost of acquisition. What is the cost of acquisition of original share? 75,000. You can index that because it is in the year 2001, 2002. So into 348 divided by 100. And can you help me with the indexed cost of acquisition? 2,61,000 round figure. How about right share? You cannot claim any indexation. Why? Because right share is a short-term capital asset. Why? Because he received that right share in which year? August 2022, right? Or 2023? It is September 2023, right? He renounced the company. There is actually a small mistake in the question, seems like. They are saying month of August to, it's no mistake. August 2023. And he renounced it in September 2023. Okay, no mistake. It's perfect. So he received only in August 2023 and sold it in that year itself. Are you with me? He sold that year itself. January 2024, he sold that particular shares. So you tell me, it will be a short-term capital asset, and how much is the right price? 160 into 200 shares. And can you help me with the math? 32,000 will be the cost of acquisition. And how about the right entitlement? Nil. How much will be the long-term capital gain in the first case? 39,000 will be the LTCG. How much is the short-term capital gain in second case? 28,000. And how much is the short-term capital gain in the third case? 6,000. Now it's not over. You have to compute the impact of Mr. Q as well. So when it comes to Mr. Q, the full value consideration is 280 per share into 200 shares. How much is that? 56,000. How about the cost of acquisition? 190 per share into 200 shares. That will be 38,000. So can you help me with the short-term capital gain? 18,000 shall be the short-term capital gain, and that is the final answer to the question. Is that clear? Online friends, is that clear? And who was asking lots of doubts? Who was that? Aditya, have you understood? Yes, that's why I told you to solve this question, okay? You will get an idea over this. Now, let's take another concept. We have time. So, you have doubts? Any doubts? Okay. Yeah. Moving on to the next concept. We'll think about bonus shares now. Yeah. We'll think about bonus shares right now. What is bonus? Yeah. Answer yes. This is the full answer. You need the chart, including the chart. Okay. Take a picture for the chart first. Then this is the answer. In examination, this much elaboration is not required for the chart, okay? Whether you draw chart or you don't draw chart, you will not get any extra marks. But this should be there. Obviously, then only you will get marks, okay? Yes. So moving on with the next concept, bonus shares. Can you tell me what is bonus shares? What is bonus shares? Shares which is issued? Actually, it is not free, but we can say it is free. It is called as capitalization of profits. You have a lot of profits in the reserves and they are not distributing it as dividend. Instead of they are saying, using the word free. Then what will happen? Thank you so much. You are not receiving dividend, no problem. I am getting free shares. More than enough. So the company is actually making the shareholders to reinvest that particular surplus to that particular company itself. Are you with me? Now think from a shareholder's perspective. You are in receipt of some bonus shares. And after that, you are selling that bonus shares. What is the cost of acquisition of bonus shares? What is the cost of acquisition of bonus shares? Zero. You don't have to incur a cost. You will get it for free. Are you with me? So what department say? In the case of a bonus shares, the cost of acquisition shall be zero. But there is one unintended benefit that you can take in bonus shares. What is that unintended benefit? Do you remember? Whatever asset you have purchased before 1st April 2001, when you compute the cost of acquisition, either you take the original cost of acquisition or you take the fair market value as on 1st April 2001, whichever is beneficial. Do you remember that theory? In that theory, income tax department is not saying excluding bonus shares. They are only saying any capital asset purchased before 1st April 2001, you can take the fair market value as on 1st April 2001 as the cost of acquisition. Are you with me? It's actually unintended benefit. But department say no problem. It is only applicable for those bonus shares which is issued before 1st April 2001. We don't have to address it right now. So, according to that theory, what you can do is bonus shares allotted before 1st April 2001 also, you can take the cost of acquisition as the fair market value as on 1st April 2001. Are you with me? Are you with me? So you can take the cost of acquisition as the fair market value as on 1st April 2001, provided you received that bonus shares before 1st April 2001. Have you understood what I said? If the bonus shares is issued after 1st April 2001, then what will happen? Then cost of acquisition shall be zero only. Let's solve a question quickly. This is a mix of the bonus shares thing, okay? So please take question number 10. So fantastic question, Usha. Just go through that question quickly. Yes. So let's compute the answer together. How many of you have an answer? All right. Great. So listen. One second. Yeah. So Miss Usha purchases 1,000 equity shares in X Limited, an unlisted company, at a cost of 30 per share, brokerage 1%. So listen, friends. At the cost of 30 per share, in brackets they are writing brokerage 1%. What does that mean? 30% is inclusive of all the cost. Cost means what? For one share, she have expended in total 30. Yes or no? See, I bought one bottle of water. Okay, I bought one bottle of water. My cost is 100. This bottle of water, MRP is only 80. I took an auto. Okay, I took an auto for buying this bottle of water and total cost is 100. That means what? All the associated costs that I've incurred to buy this bottle of water is 100. Something similar to that they have written. Cost of 30 per share means total cost include in that purchase is how much? 30. That includes 1% brokerage. Are you with me? Nothing to do. Simply said, okay. Because in this question, anyways, we are about to take the fair market value as on 1st April 2001. Are you all here? You have some update from the KSA team. So, even if I, what do you say, leave you, you are not supposed to go, like, you have to wait here for 5 to 10 minutes, okay? You have some update from the team, okay? Yes. So the point is, I'm about to leave you within 10 minutes, but after the classes, you have to wait here only because you have some important announcement coming. I don't know whether it's important or unimportant. Something is coming, okay? Yes. Listen. Where were we? Cost. Sorry, cost. Keep quiet. So, 30%, 30 rupees in 1996. Shh. She gets 100 bonus shares in August 2000. She again gets, keep quiet. She again gets 1100 bonus shares by virtue of her holding on February 2007. So how many set of bonus shares she got? 2 set of bonus shares. One on 2000 August and another 2007 February. The fair market value of the shares of X Limited as on 1st April 2001 is given 80 rupees. On 1st January 2024, she transfers all her shares at 200 per share. Okay. So what we can do is, we will take the full value consideration. Before that, how many set of capital assets she have? Original share is there. Then first set of bonus shares there, which is received in August 2000. Then second set of bonus shares there, which is received in February 2009 or 7? 7. These are the assets she have. Now tell me how much is the full value consideration. All the shares are sold at what value? They are saying some value. All the shares are sold at 200 per share. They are saying brokerage 2%. That is not net off. Okay. They are saying all the shares are sold at 200 per share. On 1st January, she transfers all the shares 200. Brokerage is not an income. It's an expense. Are you with me? So 200 is the transfer value. From that you have to net off. It is not due to you have used the bracket. In the cost they are saying cost. Cost means every payout. Here transfer means whatever you get. That is the gross. From that you have to deduct the brokerage 2%. Okay. So what you need to do is, how many shares? Original shares? 1000 original shares. 1000 original shares into what is the value? 200 per share. And how much is the full value consideration? 2 lakh. How many bonus shares? 100 into 200 shares. And what will be the full value consideration? 20,000. How many second set of bonus shares? 1000, 100 into 200. That will be 2 lakh 20,000. Now direct expenses is there. There is the brokerage. How much is the brokerage? 2% of the transaction value. How much is 2% of 2 lakh? 4,000. How much is 2% of 20,000? 400. How much is 2% of 2 lakh 20? 4,400. Now can you tell me the NSC, net sale consideration? 1,96,000 in case 1, 19,600 in case 2, 2,15,600 in case 3. We will think about cost of acquisition. When it comes to the cost of acquisition, they are using the word cost 30. Cost means all the cost. Are you with me? Doesn't matter. Doesn't matter because it is purchased in 1990. It is purchased in 1996. So you have to always go for the fair market value as on 1st April 2001. So there is no problem, but only for the sake of saying I said it. Okay. So 80 per share into how many original shares? 1000 into index number 348 divided by 100. Can you help me with the math? 2,78,400. That will end up in loss. How much is the loss? 82,400 is the loss in case 1. Long-term capital loss. Second case, what is the cost of acquisition of bonus shares? 2 minutes. What is the what is the cost of acquisition of bonus shares? Fair market value as on 1st April 2001. Why? Because August 2000 is before 1st April 2001. Doubt, go check the calendar. You don't have to check the calendar, okay? August 2000 is before 1st April 2001. This is the problem of evening. Okay, for understanding this, you have to check the calendar. Don't check the calendar. It is 2000 August. That is before 1st April 2001. So what to do? Fair market value you can take. So 80 into 100 share into 348 divided by 100. 27,840 will be the indexed cost of acquisition. And for the third asset, nil. Why nil? Why nil? After 1st April 2001, there is no cost of acquisition. So second case loss will be 8,240. Third case profit will be 2,15,600. This is long-term capital gain and the others are long-term capital loss. Now my question is, can you adjust long-term capital loss with a long-term capital gain? Yes, you can adjust long-term capital loss only with long-term capital gain. Are you with me? Yes, set off and carry forward. You cannot adjust long-term capital loss with short-term capital gain. You cannot adjust long-term capital gain with, long-term capital loss with short-term capital gain. Not possible. But this is long-term capital gain, so you can adjust. Can you net off and tell me? What is the net long-term capital gain? 960. 60. 960. This is the final answer. Yes. So please take a note of this answer. So friends, yesterday we have completed some part of the capital gain, right? It was not in an order. Today and we will follow the order and we will complete the rest of the capital gain. So the first thing that we have to discuss today is section 45 subsection 2, that is conversion or treatment of capital asset as stock in trade. So we are about to discuss a concept called as, we are about to convert capital asset into what? Stock in trade. What do you mean by converting capital asset into stock in trade? What do you mean by converting capital asset into stock in trade? Very simple. Say, I'm an AC trader. Okay, we'll stick on to the AC itself. I'm an AC trader. I have installed an AC in my office. Okay, I have installed an AC in my office. So I'll make use of an example. Say, for example, I am an AC trader. I purchased an AC. For 1 lakh rupees. In 2021-22, okay, in 2021-22, I purchased an AC in 1 lakh rupees. Then I converted that particular AC into what? Into my, it was purchased in 2021-21 and installed an office, okay. Installed an office. It was installed an office. Then what I did is like, yeah. So thereafter, I converted that into my stock in trade. I converted that into my stock in trade in 2022-23. I converted that particular AC into my what? Stock in trade in which year? 22-23. At the time of conversion, the fair market value of the AC was say 1,50,000. At the time of conversion, the fair market value of the AC was how much? 1,50,000. Thereafter, in 2023-24, I sold that particular stock in trade. I sold that particular stock in trade and say the sales value. The sales happened at 1,80,000. Alright. So for the time being, forget about the depreciation of that particular AC. Okay, forget about that particular depreciation of the AC. So you tell me what all other things happened. I purchased an AC in the year 21-22. Then I converted that particular AC. I purchased and installed it in my office. So it is basically my capital asset. So I converted that particular AC. That means I dismantled that particular AC and packed it again. And that packing happened, or I put it as my stock in 22-23. Then I sold that particular stock in 23-24. So there are certain series of events happened in this particular example. So whenever there is a
conversion of capital asset. Whenever there is a conversion of capital asset into stock in trade, that is regarded as transfer for the purpose of capital gains. This is regarded as what, friends? Transfer for the purpose of capital gains. If it is a transfer, then you have to compute the capital gain, because there is a capital asset. Conversion is regarded as a transfer, so you must compute the capital gain over there. Are you all with me? So how do you compute the capital gain? You need to take the full value consideration as the fair market value as on date of conversion. You need to take the full value consideration, because you are not getting anything. When you are converting that capital asset into stock in trade, actually you are not getting anything. But because department say it is a transfer, you need to compute the capital gain. And how do you compute the capital gain? Very simple. On the date of conversion, how much ever is the fair market value of that particular stock in trade, you take that as the full value consideration. So 1,50,000 will be the full value consideration. How about the cost of acquisition? The cost of acquisition will be the original purchase price of, say, rupees 1 lakh. Forget about the depreciation effect of that particular AC. And you tell me, how much will be my capital gain? My capital gain will be 50,000. Now listen, moving on, it's not yet over. Then I sold that particular AC for what? For 1,80,000. So when I sell this particular AC, that will come under PGBP. Yes or no? Yes or no? What is the sales value? 1,80,000. Now for the purpose of PGBP, how much should be my cost? I need to take that fair market value as the cost now. For computing the profit under PGBP, I need to take the fair market value as my cost. And how much is the fair market value? 1,50,000. Now can you tell me how much is the profit under PGBP? How much is the profit under PGBP? 30,000 is the profit under PGBP. So listen, overall I purchased this AC for 1 lakh and sold for 1,80,000. This is what is the complete effect of that particular transaction. So the total profit of 80,000 have to be split among capital gain and PGBP. The total profit of how much? 80,000 have to be split among both the capital gain and PGBP. And the interesting fact is, both this 50,000 and this 30,000, that means both the capital gain and PGBP have to be taxed in the year 2023-24. You have to tax both the capital gain and PGBP in which year? 2023-24. That means in the year in which you sell that particular stock in trade, you have to compute both the capital gain as well as PGBP. Is that point clear? Is that point clear? Yes, normally you have to compute the capital gain in the year of transfer. Okay, you have to compute the capital gain in the year of transfer, but the point here, what they are saying is, here you need to compute the capital gain as well as the PGBP both in the year in which you sell that particular stock. Whenever you sell that particular stock to an outside person, on that day only you are supposed to compute the capital gain as well as PGBP. Is that point clear? Is that all clear? Moving on to the theory part of it. Let's see what exactly is the theory. So can you read this? Gain from such transfer shall be taxable in the year in which such stock in trade is sold by him. So whenever you sell that particular stock in trade, in that period only you are supposed to compute the capital gain. And let's see on conversion. How much will be taxable under capital gain? Fair market value as on date of conversion minus actual cost of acquisition will be taxable under capital gain. And how about the business income? Sales price minus fair market value shall be the business income. And how about the indexation effect? Indexation benefit available till the year of conversion. In this asset which we were discussing, there is no indexation. Why? Because period of holding is around 1 year only. So normally if it is a long-term capital asset and converting it into stock in trade, are you eligible for indexation? Yes, but only till the date of or year of conversion. I hope it is clear. Are you all with me? Are you all with me? So you can claim that particular indexation only till the year in which you sell that particular Sorry, you convert that particular capital asset into stock in trade. That's what they are saying. Now, there is one more note. What is that note? Can you read that note? Both the capital gain and PGBP is taxed in the year in which such converted stock in trade is actually sold. So both the capital gain and PGBP both are getting taxed in the year in which you are selling that particular stock in trade. That's what they are saying. I hope that point is clear. In this case, why we did not doing indexation, because only 1 year period of holding. FMV will be on the year in which we sell the stock in trade. No, conversion. Okay, see, FMV as on date of conversion is 1,50,000. So you have to take that particular FMV only. FMV will be on the year in which sell the stock in trade. No, it's on the point of conversion. Okay, I hope it is clear. Now, moving on with the next concepts, that is 45 subsection 2. That's what we have discussed right now. And moving on to the next point, that is section 45 subsection 5. Can you read what is 45 subsection 5? Compensation on compulsory acquisition. So tell me, friends, what do you mean by compulsory acquisition? What do you mean by compulsory acquisition? What is compulsory acquisition? Very simple. Say, for example, you have a property, okay? You have a property. That property is taken over by the government. The property is what? Taken over by the government, either central government or state government, for development of either road or any bridge or something like that. Okay, so the property is taken over by the central government or state government for the purpose of development of anything like a bridge, road, railway station, airport, whatever it is. So whenever they are acquiring your property, like a land or a building, they will definitely give compensation to the owner. Are you all listening? Whenever the government takes over a particular property, they will definitely provide compensation to the landowner or the building owner. That compensation have to be assessed under capital gain. Why? Because compulsory acquisition is also regarded as a transfer. Are you with me? Are you with me? Say I have a land and the government came and compulsorily acquired by particular land, and they will pay me a compensation, and that compensation paid by the government to me is definitely subjected to capital gain, and that's what we are about to compute. Now you tell me, what will be the full value consideration here? What will be the full value consideration in compulsory acquisition? The compensation received by the government will be the full value consideration. So total compensation or consideration received or receivable shall be the full value consideration over here. And how about the cost of acquisition? Actual purchase price. The cost of acquisition does not have any speciality because it is your actual purchase price only. Now, how about the expenditure on transfer? The legal expenditure incurred to recover the claim shall be allowed as deduction. See, in compulsory acquisition, there won't be any brokerage and all, because government is directly coming and acquiring your asset. Yes or no? But there can be legal charges for your negotiations and other things. There can be legal charges that you are incurring, and that legal charges you can definitely deduct as what? Definitely deduct as what? You can definitely deduct as was expenditure on transfer. And when is the chargeability? In the year when such compensation or consideration or part thereof is first received. Listen. Say today I had a property and government compulsorily acquired my property today. Only after 4 years I received what? Compensation. Only after 4 years I received what? Compensation. You tell me, do I have to pay taxes today or after 4 years? After 4 years only. Why? Because department say, even though the transfer is compulsory acquisition, you need not compute any capital gain and you need not pay any taxes, because we know that it will take some time. Yes or no? Because it's a governmental matter, they have to follow the procedures. So government say, don't worry, we have no plans to tax you in the year of compulsory acquisition. Rather, you pay the taxes in the year in which you receive the compensation from the government. You need to pay the taxes in the year in which you receive the compensation. That's what the department says. Now, moving on to the next one. How about the indexation? You will receive the indexation till the year of compulsory acquisition only, not till the year of receipt of compensation. If the asset is a long-term capital asset, you can claim the benefit of indexation, but only till the year of compulsory acquisition, not after that. I hope it is clear. Moving on to the next one. There's a thing called enhanced compensation. What do you mean by enhanced compensation? I've received, say I had a property, okay. I had a property, government compulsorily took over my property. I said the compensation paid by them, and they paid me 1 crore rupees as compensation. They paid me what? 1 crore rupees as compensation. I filed a case stating that 1 crore rupee compensation is very less. I filed a case stating that 1 CR compensation is very less. And there was a court hearing, and during the end of hearing, I received another 50 lakhs. I received what? Another 50 lakhs. Or the court judgment told the state government to pay an additional 50 lakhs. That additional 50 lakhs that I received as a part of the litigation is said to be what? Enhanced compensation. That means the original compensation means the compensation voluntarily given by the government. Enhanced compensation means you filed a case or something, and after that arbitration or case, you are receiving something more. And that something more is said to be what, friends? Enhanced compensation. Are you with me? Are you with me? So let's understand enhanced compensation chargeable in the year in which the same is received from the government. Whenever you receive that enhanced compensation, in that year you need to pay the taxes. Are you all with me? In the case of an enhanced compensation, whenever you receive an enhanced compensation, you need to pay income tax in the year of receipt of enhanced compensation. That's it. Now while computing enhanced compensation, you tell me whether the enhanced compensation is a long-term capital gain or short-term capital gain. For that, you need to check whether the original compensation is long-term or short-term. Enhanced compensation is only a continuation of the original compensation. So what the Act says, if the original compensation is long-term, enhanced also will be long-term. If the original is short-term, enhanced also will be short-term. Are you with me? Because enhanced compensation is another episode of original compensation. You will get that later, that's it. Okay, so what they are saying is, as in the case of initial compensation or consideration. So the nature of gain on enhanced compensation, whether it is short or long, depends upon the nature of original compensation. If original is long, enhanced also will be long. Now, along with the enhanced compensation, definitely there will be some period of time required for you to receive the enhanced compensation. Why? Because the hearing or the arbitration have to get over. Yes or no? Are you all listening? See, you will receive enhanced compensation only at the end of court hearing. So there will be some time taken in receiving the enhanced compensation. So normally the enhanced compensation will be awarded along with interest. Normally the enhanced compensation is awarded along with the interest, and that interest will be taxable under IFOS, not under capital gain. Are you with me? So interest on enhanced compensation, if any, always shall be taxable under IFOS. And there is one interesting thing. Under IFOS, you can claim a standard deduction on this interest at 50%. That means, say, you're receiving 10 lakh rupees as interest, you need to pay tax only for 5 lakh. Why? Because you can claim a standard deduction for this interest. And how much is the standard deduction? 50% of interest received shall be the standard deduction. Are you all with me? Is that point clear? Is that point clear? So this is how you have to compute the effect of enhanced compensation in Income Tax Act. So these are the two other theories which were pending yesterday. So we have completed that. And mode of computation of capital gain, indexation, etc. we have already done. And there is one point that you have to be careful. While computing capital gain in respect of a listed share or security, while computing capital gain in respect of a listed share or security, STT paid shall never be allowed as a deduction while computing the capital gain. What is STT? Security Transaction Tax. Say I have purchased some listed shares. Thereafter some period of time I sold that particular listed shares. Now the question is, can I claim the STT that I paid at the time of purchase and sale as a deduction? The answer is never. Never. While computing capital gain, you are not supposed to include STT paid as a deduction. Are you all with me? Ali Nivas, because today we have an agenda. We have to finish off the other things. So I have no plans to give you a question in compulsory acquisition. Okay. So you have to adjust because today we have an agenda. We have to finish this IFOS and we have 115 BAC, okay, which are more important than this. So let's stick on to the agenda. If that gets over, definitely I can throw you some questions on that, okay? Yes. Why STT is not deducted? Because that you have to ask to the central government, okay? It's a rule. They are saying you cannot claim security transaction paid as a deduction. That's it. Yes. So moving on to the next point, index table and all we have already computed. Now there is a note under this. Can you read this note? Cost of acquisition or cost of improvement shall not include any expenditure or a deduction which is already claimed by the assessee either under section 24B or under chapter 6A. Say for example, imagine a case. Say I purchased the house. I purchased the house by taking a loan. By taking what? A loan. The interest that I'm paying, say if it is a self-occupied property, okay? Say it is a self-occupied property and the cost of the house was say 10 crore. Okay, I will bring it down. 50 lakhs. The cost of the house was how much? 50 lakh. The interest that I paid is 10 lakh. The interest that I paid is how much? 10 lakh. But for this interest, you can claim a deduction under 24B, house property. Whether it is self-occupied, whether it is let out, whatever it is, whether it is deemed let out, the interest that you are paying is allowed as a deduction under 24B. Now the question is, say I am selling this house property. I am selling this house property for 80 lakhs. How much is my cost of acquisition? Is it 50 or is it 60? It is only 50. You cannot claim 60. Why? Because that 10 you have already claimed as a deduction under 24B. That's what this note is all about. While computing the cost of acquisition or cost of improvement, it shall not include any expenditure or reduction which is already claimed by the assessee under section 24B or under chapter 6A. Are you with me? Are you with me? So whenever you are computing cost of acquisition, you are not supposed to consider what? All the deductions that you have claimed under 24B or chapter 6A deduction. I hope it is clear. Say 50 lakh is the cost of the asset. 10 lakh is the interest that I paid. That interest I have already claimed as a deduction under 24B. Now I have sold this asset for 80 lakh. Now the question is, can I claim this entire 60 as cost of acquisition? The answer is no. I cannot claim this 10. Why? Because it is already deducted under 24B. Okay, yes. PGBP 36 is different, okay? That is for PGBP, okay? Yeah, STT is same. There is only one STT. If you are a full-time trader, you can claim the STT paid as a reduction under 36. If you are an investor and all, like doing this trading as a capital gain activity, then you cannot claim this STT paid as a deduction. That was the point is. Government acquired my land, government paid 10 lakhs as compensation. After 2 years, I got 3 lakhs as enhanced compensation. For enhanced compensation, cost of acquisition will be 0, Alinivas. Why? Because while at the time of receipt of original compensation itself, you might have claimed all the cost of acquisition, okay? So for the enhanced compensation, cost of acquisition shall be 0. Got it? Is interest which has not allowed as deduction partly can be included in the cost of acquisition? Yes. Interest, if it is not allowed as a deduction, then you can consider that as a cost of acquisition. Yes. Yes, Shashi, it's possible. Now, moving on to the next point, we were discussing about indexation and the other thing. We have computed already, we have finished how to compute long-term capital gain, how to compute short-term capital gain, indexation and all, we have already completed yesterday. Now, let's move on with the other things here. What are the other things? Section 49, ascertainment of cost of acquisition in certain specified circumstances. Can you read that point number 1? We were about to determine the cost of acquisition special circumstances, and let's understand each cost of acquisition point one by one. So I want all of you to be very attentive right now. So listen friends, what do you mean by determination of cost of acquisition in certain special circumstance? What do you mean by determination of cost of acquisition in certain special circumstance? Very simple. In certain circumstance, while determining the cost of acquisition, you have to follow the things which we are about to discuss right now. Are you with me? in certain circumstances, when you compute cost of acquisition, you have to mandatorily follow the things which we are about to discuss. And let's understand which all are the circumstances. Okay, let's understand which all are the circumstances. So can you read that point number 1? In the following cases, cost of acquisition to the previous owner deemed as cost of acquisition of asset, where the capital asset become the property of the assessee on total or partial partition of HUF or under a gift or a will. I have only selected important items under this. Okay, we have a lot more items under this, but I have only selected 2 important things under this. What does that mean? Very simple. I'll create an example so that you will get a better idea on what exactly is that particular point. Listen, say for example, say father, Mr. Father purchased an asset in say 2010-2011 for 10 lakhs. For what value? 10 lakhs. He transferred this property in the name of his son. We can say Mr. Son. He transferred or gifted, we can say gifted. He gifted this particular property in the name of Mr. Son, and this gift happened in the year 2016-2017. Mr. Son got this particular asset, or we will take a later date. Say 2021-22, Mr. Son got that particular asset. It is a gift from his father. Then what Mr. Son did? Mr. Son sold that particular asset. Okay, Mr. Son sold that particular asset in 2023-2024 for a value of 50 lakhs. Sales value was how much? 50 lakhs. While computing capital gain, which all are the things that you have to be careful. Let's see. Say, who is the transferor in this example? Son. Son is the transferor. So for son, how much will be the full value consideration? 50 lakhs. For son, full value consideration will be what? 50 lakhs. For son, what is his cost of acquisition when he sells that asset outside? For son, what will be his cost of acquisition when he sells that particular asset outside? You tell me. What department? Say in such scenario, you can take the cost of acquisition of your previous owner. So while taking cost of acquisition, previous owner's cost you can take as your cost of acquisition. That means father's cost you can take as cost of acquisition. Now the next thing, while computing period of holding, you can take the date of purchase of asset by the father till the date of sale by the son. So period of holding will be from 2010-11 to 2023-24. While computing period of holding, date of purchase of asset from by the father till the date of sale by the son you can take. The next thing, how about indexation? There is a problem. Indexation, Income Tax Act is actually silent. Okay, about indexation, Income Tax Act is silent. So in that case, there is a thing called Manjula J. Shah. Manjula J. Shah is a case which is cited by the Bombay High Court. It is a case, name of a case, Manjula J. Shah, cited by the Bombay High Court. And what Bombay High Court says in this particular case is very simple. While computing indexation also, you can take indexation from 2010-11 to 2023-24. You can take indexation from 2010-11 to 2023-24. Are you with me? Are you with me? So whenever there is a gift from father to son, and son is selling that particular asset outside, then what you need to do is, you need to what? The cost of acquisition of the previous owner shall be the cost of the transferor. The period of holding also starts from the date of purchase of the asset by the previous owner till the date of sale. And while computing indexation also, you can take the previous owner's date till the sale by the transferor by quoting this case law called as Manjula J. Shah. You don't have to write Bombay High Court and all, but you have to write the case name. That will be better. Are you with me? So you tell me, while computing this, how much will be the indexed cost of acquisition? Can you help me with the index numbers from the revision note? Into 348 divided by 167. And how much will be the indexed cost of acquisition? 20 lakh 80,000. 8,383. 83,832. And tell me how much will be the taxable long-term capital gain? 29 lakh 16,168 will be the long-term capital gain taxable. I hope it is clear for you. Are you all with me? So, and one more thing, this gift by the father to son is not a transfer, okay? Not a transfer according to the income tax law. This is not regarded as a transfer. Yes. What if son paid nominal amount? Then it is not a gift. It's a proper purchase. Okay? Yes. Now moving on with the next item, and there is one more thing, total or partial partition of HUF. What do you mean by total or partial partition? Instead of father, say an HUF bought an asset. Okay, one of the members of an HUF told that I'm not interested in doing joint business. I want my share, I'm going out. That HUF given that particular asset to the outgoing member. Okay, the HUF given that particular asset to that member who is willing to go out from the family. So the circumstance is same. Instead of father it will be HUF. Instead of son it is the going member. Then the rest is same. The going member after some years is selling that asset. The cost of acquisition will be the cost of acquisition of HUF. And the period of holding have to be started from the date of purchase of asset by the HUF till the date of sale by the member. Indexation also from the date of purchase of HUF till the date of sale by the outgoing member by quoting Manjula J. Shah. I have given these as notes. In the above circumstances, period of holding of the transferee, period of holding of the asset by the previous owner shall be considered, and benefit of indexation in the above circumstances can be claimed from the date of holding of the asset by the previous owner till the date of transfer. That is Manjula J. Shah. BOM means Bombay High Court. Are you with me? Are you with me? Great. Now, point number two that you will understand under when we discuss IFOS, okay? Whenever a gift is taxable in the hands of, recipient, one second. Yeah. So whenever there is a transfer and that transfer is taxable in the hands of recipient, then you have to make use of that taxable value as the cost of acquisition on its subsequent transfer. This you will understand after completing IFOS, taxation of gift. Taxation of gift is there. That is the next thing that we are about to discuss soon after finishing capital gains. Okay. Taxation of gift. After completing that, you will understand what exactly is this note. Now, cost of acquisition of different assets, yes. Let's understand the next cost of acquisition. Right shares we have already completed last day, okay. So, next is goodwill of a business or a profession. How about goodwill of a business or a profession? What is the cost of acquisition? In the case of a self-generated goodwill, and I'm selling that particular goodwill outside, what will be the cost of acquisition? You tell me what will be the cost of acquisition? 0. Why? What is self-generated goodwill? I'm doing good business. Automatically, I have a brand name. That brand name I got without any extra money. I have to do good business. I'll automatically get that particular brand value. Are you with me? It is right that you have to do advertising and all for getting a good brand name, but that is only for your sales. That advertising you have already claimed as your business expenditure. So, to generate goodwill, department say, if self-generated goodwill, the cost of acquisition shall be always 0, nil. How about purchased goodwill? Say I purchased this KS Academy, this brand name, okay, by paying 10 crore rupees. Okay, now after 4-5 years, I'm selling this for 15 crore rupees. Now if I'm purchasing the goodwill, then the cost of acquisition will be what? Cost of acquisition will be what? The original purchase price. That's it. Then the cost of acquisition will be the original purchase price, and this is what we can say. Are you all with me?
So this is what we can say in the case of a purchased goodwill and self-generated goodwill. So in the case of purchase, cost of acquisition of the purchase price. In case of self-generated assets, cost of acquisition shall be nil. And for goodwill of a business or a profession, the cost of improvement shall be always 0. Why cost of improvement is always 0? You don't have to incur anything for what do you say? For increasing the value, okay? For increasing the value or for generating more goodwill, you don't have to incur any extra cost. You do good business. So the cost of improvement of goodwill shall be always 0. Yes. Bonus shares we have already completed. Then do you remember what if you have to do if you are purchasing an asset on or before 1st April 2001? Then the fair market value as on 1st April 2001, that also we have already done. Now, there are certain things while computing the long-term capital gain under section 112A. That's what we are about to discuss. So, before discussing that, let me jump into the rate of taxes. Okay, let me jump into the rate of taxes. We will discuss the rate of taxes that are applicable in the chapter capital gain, and we'll finish this and we'll come back to the 112A cost of acquisition special scenario. Are you all listening? Are you all listening? So this rate chart will actually help you in understanding what are the rates and what are the other conditions in relating to the particular rate of taxes in capital gain. So we can call this as a rate chart. We can call this as what, friends? A rate chart in capital gain. So moving on to the first item, how many types of rates we have in capital gains? We can say 3 flat rates and 1 common rate. 3 flat rates means long-term capital gain under 112 is there. Long-term capital gain under 112 is there. Short-term capital gain under 111 is there. And normal short-term capital gain is there. We can split that into 4 normally. So we'll start with the short-term capital gain under 111A. Are you all listening? So you tell me, what is the short-term capital gain under 111A? Short-term capital gain on transfer of listed equity share of a company where STT is paid at the time of purchase and transfer. What do you mean by listed equity share where STT is paid at the time of purchase and transfer? Very simple. You purchase some listed shares. You hold it for some period and you're selling that particular listed share. And the period of holding is how much? 12 months or less. Then the gain that you're getting will be a short-term capital gain, and that shall be taxable under 111A. And what will be the rate of tax? Flat rate 15%. Do you remember, I have given you an outline on how to apply the rate of taxes, a thumb rule. If for a particular income, rate have been specifically mentioned in the IT Act, you have to apply that rate. If a specific rate is not in there in the IT Act, then you have to apply the slab rate. Do you remember this? Do you remember this? So this is actually something related to that 111A. What they are saying is, if you have a short-term capital gain on transfer of a listed equity share or a listed unit of equity-oriented fund or a listed unit of a business trust. So you have 3 assets. If you have what? Short-term capital gain on listed equity share or unit of equity-oriented fund. What is this unit of equity-oriented fund? Majority of investments of a mutual fund, if it is in equity, then we can call that particular mutual fund as an equity-oriented fund. If majority of investment is in debt, then we can call that mutual fund as debt-oriented funds. If it is mix, that means 50-50 mix and all, we normally call it as hybrid funds or hybrid mutual funds. Are you with me? Are you with me? So a mutual fund that predominantly focuses on equity is said to be equity-oriented fund. And if you have invested in that equity-oriented fund, you will be called as a unit holder of that equity-oriented fund. And you are that equity-oriented fund's unit holder and selling that particular units, and you are having a short-term capital gain, that will be subjected to what rate, friends? 15% rate of tax under section 111A. Are you with me? Or a unit of business trust where STT is paid at the time of transfer. Business trust means REIT, Real Estate Investment Trust and Infrastructure Investment Trust in India. two things are normally considered as business trust in India, REIT and InvIT. Similar to mutual fund, REIT, how does it work is like you can invest in REIT. REIT will make use of your investment to generate profit from real estate. Real estate investment trust. They will generate rental income, transfer income, development income, etc. Are you with me? And there is InvIT also, infrastructure investment trust. You can invest in that trust and that will actually develop the infrastructures, make profit and distribute it to the unit holders. So there are two types of trust that is called as REIT and InvIT. These are called as business trust in India, REIT. Real Estate Investment Trust, and InvIT. InvIT means Infrastructure Investment Trust. These two are called as business trusts. If you have units, that means if you have invested in these two trusts, then that unit you are selling and you are having a short-term capital gain, then that short-term capital gain is subjected to what rate? 111A, 15%. Are you with me? Are you with me? So very simple, friends. So you have three assets. Which all are the three assets covered under 111A? Which all are the three assets covered under 111A? Listed equity share or listed unit of equity oriented fund or listed unit of business trust. If the gain that you're having is a short-term capital gain, then the rate of tax will be at 15%. Moving on to the next one, there are few notes in relation to this. While computing this 15% short-term capital gain, you have to be careful about certain things, and let's understand which all other things that you have to be careful. So listen, assessee being resident individual or HUF can claim unexhausted basic exemption limit. Can you read this again? Assessee being resident individual or HUF can claim unexhausted basic exemption limit. Can you tell me what is this unexhausted basic exemption limit? So I'll give you an example to understand what exactly is this unexhausted basic exemption limit. Are you all listening? Are you all listening? Say for example, friends, say I am an individual, opted out from 115 BAC. Opted out from 115 BAC means I've opted for the old slab. Okay. So, and I am having some PGBP income of rupees 1 lakh. And I'm having short-term capital gain taxable under section 111A, that is say 5 lakh. I'm having short-term capital gain taxable under 111A. How much is that? 5 lakh. So can you help me? How much is my total income? How much is my total income? How much is my total income? 6 lakhs is my total income. While computing tax liability, you have to split this into two. Number one, PGBP income, that will fall to the slab. This will be subjected to the slab rates. And how much is my basic exemption limit? Basic exemption limit is 2,50,000, but my income is only 1 lakh. So there is something balance in the basic exemption limit. And how much is the balance in the basic exemption limit? 1,50,000. This is called as unexhausted basic exemption limit. This is called as what? Unexhausted basic exemption limit. Are you all with me? Now, not yet over, friends. There is one more thing. See, you have short-term capital gain, which is taxable under section 111A. How much is that short-term capital gain taxable under 111A? It was 5 lakh. Now, with this 5 lakh, first of all, you need to check whether you have some unexhausted basic exemption limit. The answer is yes. If you are a resident individual or resident HUF, then alone you can claim this unexhausted basic exemption limit as a deduction from the short-term capital gain. Only resident individuals and resident HUFs alone can claim this adjustment. If you are a non-resident, you cannot do this. That unexhausted basic exemption limit is gone. Are you with me? Are you with me? It's not your right, it's a given benefit. What do you mean by not a right? For certain persons with certain income, income tax department have given this right. And the certain incomes are incomes under capital gains, not with any other incomes. Say for example, you have some casual income, taxable at 30%. Can you adjust unexhausted basic exemption limit? No. If it is given, then you can claim it. That's what I said. It's not your right, it's a given benefit. Are you with me? So that 1,50,000 I can adjust. And can you tell me how much will be my net income? 3,50,000 will be subjected to 15% rate of tax. And can you tell me how much is 15% of 3,50,000? 52,500, and there will be 4% cess. And how much is 4% cess? 2,100. So 2,100. Adding these two, how much will be my total income? 54,600 will be my total tax liability. Are you all with me? So adjusting unexhausted basic exemption limit means if you have some other income and that income is less than the basic exemption limit, the balance of that basic exemption limit is said to be what? Unexhausted basic exemption limit. I hope it is clear for you. Are you all with me? Is that point clear for you? Great. Yeah. So moving on with the next adjustment. Can you read the next adjustment? From short-term capital gain taxable under 111A, you cannot claim any Chapter 6A deduction. You cannot claim any Chapter 6A deduction from short-term capital gain taxable under 111A. It is restricted. Are you all here? And what is the final note? You can claim rebate under 87A if your total income is less than or equal to 5 lakh. If your total income is less than or equal to 5 lakh, you can claim rebate under 87A. There is no restriction for the rebate under 87A. But right now, there is a thing speculating in the market. Like they are in the latest income tax return, they are not providing this relief. They are not providing this relief. And there is some kind of tweets and all is happening. It's not officially confirmed whether it is a glitch or whether it is a part of the act. Because act, they are not saying any restriction. The restriction is only for long-term capital gain. Under 112A, you cannot claim this rebate. But 111A does not have any such restriction in Income Tax Act. But in the latest return, they are not providing this relief. That is not our concern. For our examination purpose, from 111A income, you can definitely adjust the rebate under 87A because whatever restriction provided in the Act only will be the restriction. The rest we can take according to our wish. Are you with me? It's totally unfair. That is happening right now. It's totally, that I can clearly say, it's totally unfair because they are not supposed to do things like that. If they want to restrict, they have to do it only through the Act. Because this is actually a serious restriction. So if they want to restrict, they have to only supposed to do this by amending the law, by putting a specific restriction. Otherwise, it will speculate. Certain people will say deduction possible. Certain people will say not possible. Why? They can make clarity easily. Okay. Yeah. So moving on with the next one, friends. What is the second item? Flat rate taxable. Can you read the heading? Long-term capital gain under section 112A. So let's understand what exactly is this long-term capital gain. Can you read the heading? Can you read the text? Long-term capital gain over and above 1 lakh on transfer of listed equity share of a company where STT is paid at the time of purchase and transfer, or unit of equity oriented fund or unit of business trust where STT is paid at the time of transfer. So short-term capital gain under 111A, long-term capital gain under 112A, but under 112A there is a benefit. What is the benefit? Only over and above 1 lakh is subjected to 10% rate of tax under section 112A. That means if you have a gain of say 1,30,000, you need to pay 10% rate of tax only on that 30,000, not on that 1 lakh. Are you with me? If your long-term capital gain under 112A exceeds 1 lakh, only that excess portion is subjected to 10% rate of tax and the rest is not subjected to any taxes. Are you with me? Up to 1 is not subjected to taxes. It's just like a special exemption limit under 112A. Moving on. assessee being resident individual or HUF can claim what? Unexhausted basic exemption limit. I hope you understand what is this unexhausted basic exemption limit. You don't require any other example because I've already finished an example. If you have an unexhausted basic exemption limit, you can adjust that with the long-term capital gain under 112A as well. But there is one condition for that. You tell me, what is the condition? What is that condition? You have to be a resident individual or resident HUF. Then only you can adjust this. Otherwise, you cannot adjust this. Are you with me? Are you with me? Yes. Old RAIM, basic exemption is 2.5 and new RAIM, basic exemption is 3 lakh. Depends upon which RAIM you have taken. Okay. So, moving on with the next one. Here also you cannot claim any Chapter 6A deduction. From 112A long-term capital gain as well, you cannot claim any Chapter 6A deduction. It is restricted. Moving on, you cannot claim the benefit of 87A rebate over here. 87A rebate is not given. Why? Because when they announced the annual budget in 2019, there was a note saying that we are already giving you a benefit of 1 lakh as a special exemption limit under 112A. Along with that, we are not providing any benefit under 87A. That was the very idea of restricting 87A benefit from 112A. That's why my objection. You cannot restrict under 111A. You can restrict, but you have to amend the law. Simply coming and saying you will not give you, that's not fair. This is India. These kinds of things are not possible. Okay. If you want to restrict, you amend the law. Then you restrict. Or CBDT have to officially issue a clarificatory note or a circular stating that will not give you. That also is objectable. Why? Because it is not a change in the law. Act, if it is amended, then definitely we all are bound to accept that, and we will all accept that also. Now, moving on, the next point, even if it is a long-term capital gain, you cannot claim the benefit of indexation while computing long-term capital gain of listed share, listed equity oriented funds, listed unit of business trust. Don't come and ask for indexation. We will not give you, because we are only taxing you at 10% rate of tax. Are you with me? We are only taxing you at what rate? 10%. With that, don't claim any indexation as well. I hope that point is clear for you. 112A, 5 lakh. I can deduct 1 lakh under 112A. In this case, can we claim unexhausted basic exemption limit of 4 lakh? How do you get unexhausted basic exemption limit of 4 lakh, Ali Nivas? First of all, the basic exemption limit is only 2.5 lakhs. If you are a super senior citizen resident, then it is possible. Otherwise, not possible. Okay. Yeah. So, moving on to the next point. Let's understand what exactly on the next. On 4 lakh, you can adjust. Yes, yes. 4 lakh is not unexhausted basic exemption limit. On 4 lakh, you can adjust. Yes. Yes, yes, yes. Yes, Alinivas. That's right. On 4, it is possible. That means 2.5 you can adjust with the 4. And how much will be the rest? 1.5 into 10%. That will be around 15,000 plus 4% that will be the tax liability in this case. Yes, that's right. Oh, that was actually my mistake. Okay, I thought I didn't read that on. I read unexhausted basic exemption limit 4 lakh. Yes. Yeah. Moving on to the next one. Where were we? You cannot claim the benefit of indexation while computing the long-term capital gain under 112A. And there is one more thing under 112A. That is what we are about to discuss right now. That is the special circumstance while determining the cost of acquisition. Let's see. Let's see. There is a special case while determining the cost of acquisition, and let's understand what exactly is this cost of acquisition. Please listen, friends. Please listen. Say, for example, I'll give you a case, okay? I'll give you a case. Before that, let's read the theory. Can you read the heading? Long-term capital asset under section 112A, its cost of acquisition. So, read the first box. Cost of acquisition if assets are purchased on or before 31st January 2018, you take either the actual cost of acquisition or lower of fair market value as on 31st January 2018 or full value consideration. What do you mean by this? It seems like very confusing, but there is no point of any confusion. What the Act says is, if you are purchasing any listed shares or listed units of equity oriented fund or listed unit of business trust on or before 31st January 2018, which is the date on or before 31st January 2018. Then while computing the cost of acquisition, there is a special formula for you. While computing the cost of acquisition, there is a special formula for you. What is the special formula? Either you take the original actual cost of acquisition, or you take lower of fair market value as on 31st January 2018 or full value consideration at the time of sale. That simply means you first check the FMV as on 31st January 2018. Then you compare it with the full value consideration at the time of sale. Compare these two and pick the lower. Either this lower figure or actual cost of acquisition, whichever is higher, that will be beneficial. They are not saying higher in that. They are saying either actual cost of acquisition or lower of these two at your choice. That's what the interpretation is. They are not saying higher, but it should be higher because it is your cost. Are you all with me? I'll give you an example for a better clarity over this provision. Listen. Say I purchased one share of Tata Motors, say for 1,000 rupees in 2015-16. Okay. In 15-16, I bought one share of Tata Motors for what value? 1,000 rupees. The fair market value of Tata Motors share as on 31st January 2018 was, say it is 1,400 rupees. The fair market value of Tata Motors as on 31st January 2018 is how much? 1,500 rupees. Sorry, 1,400 rupees. Later on in 2023-24, I sold this shares for 2,000 rupees. I've sold this shares for what value? 2,000 rupees. Are you all with me? Let's understand how do you compute the cost of acquisition in this example. So listen, to compute the cost of acquisition, the first figure that you require is the full value consideration. How much is the full value consideration? 2,000. How about the cost of acquisition? While determining cost of acquisition, Tata Motors being a listed share, what you need to do is you need to check whether the date of purchase is before 31st January 2018. You tell me, when is the date of purchase? Is it before 31st January 2018? Yes, it is before 31st January 2018. So what you need to do is, you need to take the original cost first. How much is the original cost? 1,000 rupees. Let it be there. Now you need to take the lower of the fair market value as on 31st January 2018, that is 1,400. Or you need to compare it with the full value consideration 2,000. And you need to pick the lower. Which is lower? 1,400. And you need to compare these two and pick the higher. That will be 1,400. You deduct this 1,400 from 2,000 and the rest 600 rupees will be your capital gain under 112A. Are you all with me? This is how you have to compute the cost of acquisition if the shares are covered under 112A. Are you all here? Is that point clear? So whenever you are purchasing a listed share or a listed unit of equity oriented fund or a listed unit of business trust, and if the date of purchase is before 31st January 2018, then while computing the cost of acquisition, you have to make use of this particular formula. And what is the formula? Either you take the original cost of acquisition and put it over there. Then you compare the fair market value as on 31st January 2018 with the full value consideration at the time of sale, and you compare these two and pick the lower. Then that lower and the original cost of acquisition have to be compared, and you have to pick the higher. Act is not saying you have to pick the higher, but obviously you can, it's an option given. Original cost or lower of these two. That's what the Act says. That's why we have made that column like that. I haven't mentioned whichever is higher. That is obvious. Are you with me? Are you with me? So this is how you have to compute the original cost of acquisition. Now let me tell you one thing. What if I purchase that share after 31st January 2018? What if I'm purchasing that particular share after 31st January 2018? If it is after 31st January 2018, then normal cost of acquisition. The original purchase price itself only I can take as the cost of acquisition. There is no speciality over there. Are you all with me? Is that particular point clear for you? Great. This is how you have to compute the cost of acquisition of assets covered under 112 day. Is there any reason for the PIC of the cost of acquisition? Yes. Yes, there is. There is. Because that reason, I'll take around 15 to 20 minutes to explain. So forget about it. There is a reason. Because earlier, before 2018 annual budget, it was exempted under 1038. Then they brought in this particular taxation under 112A suddenly on February 2018 annual budget. So this is called as a grandfathering clause. So I'm not planning to explain what is grandfathering clause and wasting your time. Rather, you study it as equation, okay? Because, as you know, revision, we cannot go beyond certain limits. Yes, there is a reason, yes. Moving on to the next one, we have been completed the chart yet. Let's complete the other items in the chart. You tell me which all are the items that we have completed in the rate chart? Which all are the items that we have already completed in rate chart? Number 1, we have completed short-term capital gain under 111A. Number 2, we have completed long-term capital gain under 112A. Now we are about to compute the long-term capital gain, other long-term capital gain which is under 112. Let's understand which all are the other long-term capital gain under 112. There is no slab income, only in the 112A income only. Claim BEL, basic exemption limit. Yes, yes, yes. There is no normal income means your entire basic exemption limit is unexhausted basic exemption limit. Understood, Ragul? Full basic exemption limit is unexhausted basic exemption limit, and you can fully adjust that with the 112A or 111A item. Got it? Moving on with the next one, that is other long-term capital gain under 112. Can you read the first box out of it? Can you give me an example for a other long-term capital gain? Transfer of land, transfer of building, transfer of jewelry, transfer of drawing, transfer of painting, whatever it is. All other long-term capital gains will be covered under 112. Transfer of unlisted share, transfer of debenture, transfer of bond, whatever will be coming under 112. So, what is the rate of tax for that long-term capital gain? 20% on the normal long-term capital gain. There is no special exemption and all for that. Now, while computing this, assessee can claim, assessee being resident individual and or HUF can claim unexhausted basic exemption limit from the above income. Here also you can adjust the unexhausted basic exemption limit from the above income. Now, no deduction under chapter 6A. While computing 112, you cannot claim any deduction under chapter 6A as well. Indexation allowable. Rebate under 87A allowable. There is no restriction for the rebate and there is no restriction for the indexation, but there is a restriction for chapter 6A deduction. Are you all with me? Now how about the other short-term capital gain? That means transfer of land, transfer of building, transfer of debenture, transfer of unlisted share. If you have normal short-term capital gain, then that will be taxed as normal slab rates. It is a taxed as a part of the normal slab rates, just like a normal common income. You can claim all the deductions. It directly falls to the slab, so directly you can claim the basic exemption limit. Chapter 6A reduction permissible, rebate permissible, so everything is permissible. It is considered as a normal income only. Are you with me? There is no flat rate for the other short-term capital gains, and I hope it is clear. Come again? That is unlisted. 112 is obviously listed. That is STT is paid at the time of purchase and sale. Unlisted means it is under 112. You can claim the indexation benefit. Absolutely no problem. Listed na, it will be under 112A. No indexation benefit. Understood? Great. So moving on. Aditya, don't discuss the latest budget things right now because you are writing your September and January. For that, that is not required. Okay, so don't discuss that here. If they discuss that here right now, students are learning the other one. So if I mix that along with this, then what will happen? Everybody will go wrong. So don't take the latest annual budget right now. Okay. Nandri solla unakku vaartha illai. Oh, this is a song. Okay. Ali, what is this? You are singing over there. Sir, long-term capital gain on listed share not paid STTR. Not possible.
Not possible, Maunika. You cannot, it's not an option to you. If you are trading through RSC, along with the purchase price, you have to mandatorily pay STT. Okay. You cannot transfer listed share without paying STT. It's not a choice. If it's a choice, nobody will pay STT. Yes or no? Why should we pay STT? People will never pay STT. It's not a choice. It is mandatory. Kodutte agano. Okay. Yes. So this is how you have to compute the capital gain. Now let me give you a question. You were saying you want tough question, right? Yesterday onwards, somewhere, some people in the online were saying tough question. Okay. Ida, the podunga. Take question number 13 in your page number 4. It's a fantastic question. You need to compute the capital gain as well as the tax liability. You need to compute everything. Read that question carefully, otherwise you will go wrong. Okay, read that question carefully and give me the answer. Mithun purchased 100 equity shares of Messrs. Good Money Company Limited on 1/4/2006 at a rate of 1,000 per share in the public issue of company by paying STT at the time of security transaction tax. The company allotted bonus in the ratio of 1:1 on 1/12/2022. He has also received dividend of 10 per share on 1/5/2023. He sold all the shares on 1/10/2023 at a rate of 4,000 per share. So, Messrs. Good Money Company Limited issued 100 shares. That was original shares, okay? 100 shares, we can say original shares, which is listed. This was acquired by Mithun in the year 2006. Then they issue bonus shares 1:1. That means 100, sorry, not 1,000, 100 bonus shares. That issue was in the year 2022. Then in 2023 October he received dividend. You tell me at the time of receipt of dividend how many shares he have? 200 shares he have. So 200 shares into what is the amount of dividend that he received? 10 rupee per share. That means 2,000 rupees he have received as dividend. Are you with me? So 2,000 rupees he have received as dividend. Then he sold all the shares on 1/10/2023. So friends, whenever you get a question in exam, you first give some time to understand the question, okay? Read peacefully and understand the question. Are you with me? You should act mechanical. You shouldn't act mechanical, okay? It is like you just pick the figures and write the answer. It shouldn't be like that. Always sit, relax and read the question. Are you with me? It's very easy to say to sit and relax because during the time of examination your stress level will be comparatively higher. But you can relax. If you have prepared very well, you can control your stress. See, imagine a situation you have prepared very well. Then what will be your attitude? Your confidence will be high. You want to somehow write the exam. Are you with me? That is possible. Invest your time right now. From today onwards, today we are finishing our revision classes. So maybe tomorrow and after tomorrow you will be having some other revisions also. I don't know whether you have revisions or not. If you have or haven't, whatever it is. From today evening onwards, don't postpone it to tomorrow. Tomorrow also you will say tomorrow. Then also you will say tomorrow. Today evening itself, you start your preparation. Today evening itself, start with the direct tax. Start with the direct tax because you have that 4 days backup you have. We have touched all, I'm not saying we have completed 100%, but we have touched most of the areas we have touched. So start with the direct tax today evening itself. You will get that momentum. You will get that momentum. Try to solve as many questions you can and that will definitely you will be able to crack taxation paper, that too with a very good marks in exam. Okay. So let's understand he sold all the shares. So original shares we'll compute the full value consideration. 100 shares into what is the price money? 4,000 rupees, not 2,000. We've sold it for 4,000 rupees and that will be 4 lakh. How about bonus shares? Same, 100 into 4,000, that will be 4 lakh. How about dividend? 2,000 rupees, let it be there. Now, is there any direct expenses on transfer? Direct expenses, yes, there is brokerage at 1%. STT is not a direct expense. You cannot claim STT as a direct expense. You can only claim brokerage. 1% brokerage means 4,000, 4,000. 1 or 2? 1%. So how much will be the net sale consideration? 396, 396.
Now, how about cost of acquisition? Of original shares, original cost of acquisition is how much? 1000. Or lower of. The fair market value as on 31st January 2001 is 2000. Or full value consideration at the time of sale is 4000. You compare these two and pick the lower, that will be 2000. And compare this 2000 with the original cost of acquisition and pick the higher, that will be 2000. So 2000 will be the cost of acquisition into how many shares you have? 100 shares. Can you claim the benefit of indexation? Can you claim the benefit of indexation? No. Why no? There is no index number in the question. Huh? No. Because there is long term. Yeah. Long term. I didn't get it. Like, come again. Yeah. Because it is long term capital gain under 112A. So the remaining long term capital gain will be 1,96,000. And here, since bonus shares, you cannot claim any cost of acquisition, and your short term capital gain will be, this will be short term and this will be long term. Why the other is short? Because you received it in 2022. You are selling it in 2023. The period of holding is less than 1 year. Are you with me? So it is short term and the other one is long term. Now can you help me? How much is the total income? You have dividend income of 2000 as well. So how much is the total income of this person? While computing total income, you have to say 5,94,000 is your total income. 92. 196 plus 396 plus 2000. What is the total income? 594. You can split this into 3. Which are the 3 splits? First of all, we'll take dividend. Dividend will fall to the slab. And how much is his basic exemption limit? How much is his basic exemption limit? 3 lakhs. Why 3 lakh? He wants to celebrate his 75th birthday. That means his age is 75. That means he is a senior citizen. His residency status they are not mentioning, but the assumption is he is a resident. If the residency status is not mentioning, then that person will be always a resident. So can you tell me how much will be the basic exemption limit? 3 lakh. And unexhausted basic exemption limit will be how much? 2,98,000 will be the unexhausted basic exemption limit. Let it be there. Now how much is the long-term capital gain under 112A? You know it is 1,96,000. From that you can deduct 1 lakh. Because only over and above 1 lakh is subjected to 10% rate of tax. So 96,000 is the balance. Now you have, 96,000. Now you have short-term capital gain under section 111A. How much is that? 3,96,000. Now let me ask you one question. You can adjust unexhausted basic exemption limit with both long-term and short-term. But we should have the priority from which you have to adjust it first. Short-term. Why short-term? Rate is 15. If you adjust it with the short-term, your overall tax liability will be less. Are you with me? Are you with me? This is called as beneficial construction. If the position is not clear in the exam, then you can, if the position is not clear in the act, then you can take a interpretation that is most favorable to the assessee. So what you need to do is you can adjust that unexhausted basic exemption limit of 2,98,000 with 396. Can you tell me how much will be the short-term capital gain after this? 98,000 will be the short-term capital gain, and this basic tax will be at 10% on 96. That will be 9,600. And here basic tax will be at 15% on 98,000. How much will be that? 14,700. And can you tell me how much is the total basic tax liability? Total basic tax liability will be 24 or 34? 24,300. And now you can claim the benefit of cess at 4%. Not benefit, you have to add, you have to pay extra cess. What is 4% cess? 972. And can you tell me how much is the total? 25,272 will be the total tax liability. I hope it is clear. All right, so moving on, friends, we were discussing about where were we? Yeah, we were discussing 112A. Now we will discuss another concept called as slum sale. Shh. Keep quiet and listen. Shh. We will discuss another concept which is called as what? Slump sale. See, imagine a situation. Imagine a situation, say, this is a business, okay? Say, this is a business. And you are the assets and some of them are the liabilities, okay? You are the assets and some of you are the liabilities also. I am selling this entire business for a lump sum value. Say there are around 300 plus assets altogether, both in online, offline, everything. Say imagine there are around 300 plus assets and we are selling all the entire business for a lump sum consideration. We are selling everything for a lump sum consideration. Say if there are 300 plus assets, how do you compute capital gain? Yes, the lump sum consideration you are getting. I am selling this entire business for a lump sum consideration. That means all the 300 assets are getting transferred in a go, in a single shot, for a lump sum consideration. So there is actually a big headache. You have to first of all proportionate that consideration among 300 assets. And you have to compute 300 computations. Yes or no? Are you all listening? Say there is a business and the business have around 300 assets. And that business is getting transferred for a lump sum amount without assigning values to the individual assets and liabilities. And that lump sum amount, you have to proportionate and you have to compute 300 computations because there is 300 transfer of assets happened. Are you with me? Isn't it a headache? It's a heavy headache, a huge headache. So what department say, in such scenario, don't treat it as a single transfer. Rather, you consider that entire business as a single asset and compute it, the capital gain in a go. Rather than splitting and rather than doing the proportion and all, you consider that entire business as a single asset. Then you compute capital gain for a entire business in a go rather than computing 300 transfers. Are you with me? This concept is said to be what? Slump sale. Treating that entire unit as a single asset and computing the capital gain. That process, that concept is said to be what? Slump sale, which is under section 50B of capital gain. So let's understand what exactly is that 50B slump sale. So can you read the heading? Capital gain in respect of slump sale. So what is slump sale? Can you read the first definition, the meaning? Slump sale means the transfer of one or more undertaking for a lump sum consideration without assigning values to the individual assets and liabilities in such sales. Very simple. Slump sale means you are transferring one or more units in a go. Okay? Without assigning values to the individual assets and liabilities. And that concept, that sale is said to be what, friends? Slump sale. Are you with me? Are you with me? Yes, now, listen, how do you compute capital gain? Let's say, I've told you that you treat that entire business as a single asset and compute the capital gain. That's what I've told you. Yes or no? You treat that entire business as a single asset and you compute the capital gain. Now, there is a problem. Whether that asset is a long-term asset or short-term asset, normally it depends upon the period of holding. Yes or no? Whether an asset is a long-term capital asset or short-term capital asset, normally it depends upon the period of holding. Period of holding means the period in between the date of purchase and date of sale. But here what department say, nature of gain shall be, if undertaking is held for more than 36 months, then long-term capital gain. Otherwise, short-term capital gain. If that entire undertaking is held for more than 36 months, then entire undertaking held means what? You've started the business for more than 36 months. The business is running for more than 36 months. Then that particular business will be treated as a long-term capital asset and the gain that is about to come will be long-term capital gain. If you are running that business for less than 36 months or equal to 36 months, then it will be a short-term capital asset and the gain that we are about to compute will be a short-term capital gain. Is that point clear? Now, we are about to discuss how do you compute capital gain in slump sale. So, listen friends, what is the format for computing capital gain? What is the format for computing capital gain?
First you require full value consideration. Then from that you can deduct direct expenses. Then you will get net sale consideration. From that you can deduct cost of acquisition or cost of improvement, whatever it is. Thereafter you will get the capital gains. Are you with me? When it comes to slum sale, what is full value consideration? Very simple. Department say either fair market value 1 or fair market value 2, whichever is higher. You have to compute the fair market value 1 or fair market value 2, whichever is higher shall be your full value consideration. What is fair market value 1? That simply means the fair market value of net assets transferred. Net assets transferred. What do you mean by net assets transferred? In a slum sale, I will be transferring some assets to a third party. Yes or no? Yes or no? For a lump sum consideration. The fair market value of the assets that I am transferring is said to be what? FMV 1. Now the question is, what is FMV 2? The fair market value of assets I received. Received as consideration. That simply means when I am transferring you, the person who purchases you should pay me some consideration. Say he is giving me money consideration, then that money will be FMV2. He is giving money plus some gold. Then fair market value of the gold and the value of money will be the consideration. He is giving me some money plus gold plus some land. Then the market value of land plus money plus gold will be the FMV2. Are you with me? Are you with me? So whichever is higher have to be the full value consideration. So the point is very simple. Whenever there is a slum sale, the full value consideration have to be either the fair market value of assets transferred or the fair market value of the consideration received, whichever is higher. Are you with me? Whenever there is a slum sale happening, either the fair market value of the net assets transferred or the fair market value of the consideration that I've received, whichever is higher have to be the full value consideration for the purpose of computing slum sale under section 50B. Is that point clear for you? Is that point clear? Moving on. What is direct expenses? Normal brokerage or commission. Your direct expenses will be the normal brokerage or commission. There is nothing special. You take the normal brokerage or commission as the direct expenses. There is nothing special. How about net sale consideration? Full value consideration minus direct expenses will be the net sale consideration. How about the cost of acquisition? Department say for the cost, you compute the net worth of the transferred business in prescribed manner. In prescribed manner. For the cost of acquisition, you do one thing. You compute the net worth of the transferred business in prescribed manner. Are you all with me? What is net worth? What do you mean by net worth? Asset minus liability is net worth. Asset minus liability is 0. Asset minus liability is 0, that's why your balance sheet is getting tallied, okay. Asset minus outside liability will be the net worth, or we can say share capital plus reserves is said to be the net worth. Are you with me? So for computing net worth, there are certain things that you have to be very careful about. So let's understand how to compute the net worth. So net worth means assets minus outside liability. Assets minus outside liability. Which all are the 4 types of assets we have? In income tax, they're saying, while computing this net worth, you have to consider 4 types of assets. Number 1, depreciable assets. Depreciable assets of the company. What should be the value for the purpose of cost? WDV as per IT Act. That means in your balance sheet, when you are transferring some depreciable assets, for the purpose of computing cost, you have to take what value? Written down value. What is written down value? The value that you have computed after claiming the depreciation is said to be the written down value. Now you tell me, what's the second type of assets? Act says assets where 100% of cost already allowed as deduction. Already allowed as deduction. What do you mean by assets where 100% the cost is already allowed as deduction? Section 35 AD specified business assets or Section 35 scientific research asset, etc., where you have already claimed 100% of the cost as a deduction. Such assets, what should be the value? Nil value. Why? Because everything you have already claimed as a deduction. Now you cannot again take any value for the purpose of computing net worth, because that net worth is your cost right now. Are you with me? Now, how about the third type of assets? It is goodwill, self-generated goodwill. Self-generated goodwill. Always take what value? Nil value. For self-generated goodwill, you are not supposed to take any value. That's what the department say. And finally, other assets. You always take the book value. Whatever the value provided in the book, you can take as the value for the purpose of other assets like debtors, stock in trade, bank balances, you take the book value, land, etc., you take the book value. Are you with me? Are you with me? So whenever you are computing the net worth, you require the total value of assets minus outside liability. While computing the total value of assets, you can split that assets into 4. Which all are the 4 types? Number 1, depreciable assets. Number 2, assets where 100% of the cost is already allowed as deduction, you take the nil value. Self-generated goodwill, you take the nil value. Other assets, you take the book value. Don't worry, everything is there in the column, okay? Everything is there. Total value of assets minus outside liability. Okay, I've simply written it as a chart, that's it. Everything is there in the revision note. Now listen. In relation to the outside liability, always take the book value. Always take the book value. Purchased goodwill, other asset, book value. Purchased goodwill, you consider it as the other asset and take the book value. So, or outside liability, you take the book value. Then this sum, this net will be your net worth without indexation. You cannot claim the benefit of indexation while computing slum sale under section 50B. Are you with me? Are you with me? You cannot claim the benefit of indexation while computing the slum sale because it is not subject to any indexation. Now the next one, while computing the value of assets, you have to ignore the effect of revaluation. What do you mean by ignore the effect of revaluation? Imagine I have a land. What? Just before my slum sale, I revalued the value of land. I revalued my land and I've inflated the value. So land is not a depreciable asset. So it will come under the other asset category for the purpose of computing net worth. Yes or no? If I inflated the value, can you take that entire inflated value as your asset value? If you take that, your net worth will be higher. Your cost will be higher. Capital gain will be lesser. Are you with me? So department says that if you have revalued anything, you need to remove the effect of revaluation. Always ignore revaluations. We will not accept any of the revaluations at the time of computing the net worth. Are you with me? Are you with me? So whenever there is any revaluation in the value of the asset, you have to ignore the effect of revaluation. I hope you got my point. Now we will discuss the theory one by one. This is the concept first of all. We will discuss the theory one by one. So can you read the cost of acquisition? What will be the cost of acquisition? Net worth of the undertaking or division, as the case may be, shall be deemed to be the cost of acquisition. Indexation benefit is not available even if it is a long-term capital gain. Now, how do you compute the capital gain? How to compute full value consideration? It is the fair market value. FMV1 or FMV2, whichever is higher shall be the full value consideration. What is FMV1? Fair market value of the capital asset transferred by way of slum sale. Now, what is FMV2? The fair market value of the consideration received or accruing as a result of slum sale, whichever is higher. Now, what is direct expenses? As usual, that is minus broker, not minus, that is normal brokerage or commission. Don't read it as usual minus normal brokerage divided by commission, okay? It's not like that. Normal brokerage or commission.
Then what is cost of acquisition? Net worth computed in prescribed manner. That is the aggregate value of the total assets of the undertaking or division minus value of outside liability for such undertaking or division as appearing in the books of accounts. However, any change in the value of asset on account of revaluation of the asset shall not considered for this purpose. You have to remove the effect of revaluation. Now, how do you value the aggregate value of assets? In the case of depreciable assets, WDV as per the provisions of Income Tax Act 1961. And capital asset in respect of 100% deduction is claimed, value shall be nil. Self-generated goodwill of a business or a profession, nil. For all other assets, book value. For outside liability, book value. This actually slum sale is very easy. Rather than computing this 300 or 400 computation, you consider everything as one single asset and compute in a shot. That's what is called as slum sale. Is that point clear for you? So do one thing, I'll give you a question. I want all of you to solve this question. That's a fantastic question, okay? Question number 12. It's your institute study question, but it's a superb question. So shall we do it together? Let's solve it together, and after that, let's go for a break, okay? So listen, friends. How do you identify whether, how do you identify whether a transaction they are referring to slum sale or normal capital gain? How do you identify? See, no individual value of any asset is considered in the transfer deed. This is the clue. Are you all listening? And in this question, they are clearly mentioning that it's a slum sale. Okay, even if it is not there, if there is a transfer of a unit or an undertaking without assigning values to individual assets and liability, then that particular transfer will be considered as a slum sale always. Are you with me? So how do you compute capital gain in slum sale? What is the first thing that you require? You tell me. What is the first thing that you require? You require full value consideration first. What is full value consideration? Full value consideration is either FMV1 or FMV2, whichever is higher. What is FMV1? Fair market value of net assets transferred. That is given in the question. How much is FMV1? 30 lakhs. How much is FMV2? That is the market value of the consideration received. Here the consideration is only money. Yes or no? Yes or no? And the money consideration received by the person is 25 lakh. And which one you have to take? The higher one. That will be 30 lakhs. Now, is there any direct expenses on transfer? Are they talking about any direct expenses? Where were we? Direct expenses, yes. Tell me what is the direct expenses on transfer? 28,000. So how much will be the net sale consideration? Can you help me? 29 lakhs, 72,000 will be the net sale consideration. How about the cost of acquisition? That you have to compute the net worth. For the cost of acquisition, first of all, you have to compute total value of assets. Total value of assets minus outside liability. First of all, let's value the total value of assets. Which all are the assets we have? Number one, building. What should be the value of building? Building is actually a depreciable asset. Yes or no? But in this question, are they giving depreciable WDV value separately? No. They are not providing WDV value separately. So what to do? Then assume that this balance sheet value is the WDV value, but there is one note is there. Revaluation reserve is created by revising upward the value of building. That simply means what? This building value of unit 1, 12 lakh, it is after revaluation of 3 lakh. Are you with me? Are you with me? Because they are mentioning that the revaluation reserve is created by revising upward the value of building. So the building's value in the balance sheet is 12. That is after the revaluation. Are you with me? So what to do? Remove that. So 12 minus 3, that will be 9 lakh only. So you should take only 12 minus 3 lakh
The rest will be 9 lakh only have to be taken as the value of building. Which is the second asset? Plant and machinery. We don't have a separate value, so we are taking that balance sheet value itself as the WDV value. Then there is debtors. It is always the book value 1 lakh. Then other assets, there is a problem. Under that there is a note. What is that? Under other assets of unit 1 include patent acquired on 1st July 2021 for 50,000 on which no depreciation has been charged. So patent is actually a depreciable asset. You should have to claim depreciation. In this question they are saying that on patent depreciation is not yet charged. So it is not the WDV value. So you need to make it WDV value. Are you with me? Because patent is a depreciable asset and the depreciation is at 25% under intangible asset category. I think yesterday we have discussed that. Do you remember? So what you need to do is we need to take a computation for patent. So patent. When is the date of purchase for patent? It is purchased on 1/7/2021 and what is the purchase value? 50,000. So 21-22 depreciation at 25% will be how much? At 25% will be 12,500. And how much will be the closing WDV? 37,500. Now not yet over. You have to compute the depreciation for 22-23 as well because the slum sale happened in 1st April 23. That is 23-24 only slum sale happened. So there are 2 years and you have to remove depreciation for the 2 years as well. Are you with me? So can you tell me how much is 22-23's depreciation? 25% on 37,500. 9,375 you have to deduct. And how much will be the closing WDV? 28,125 will be the value of patent. So you have to take 28,125. Now, there are other assets also. Excluding patent, how much is the other assets? 1,50,000 minus 50,000. So, excluding patent, the value will be 1 lakh. Now, can you tell me how much is the total value of asset? Total value of asset? 14 lakh, 28,125. How about liability? Which all are the liabilities? Creditors you have. Creditors is an outside liability, 1,50,000 into what percentage? 25%. And how much will be the value? 37,500. So the value will be 37,500. How about bank loan? How much is the total bank loan? 2 lakh. Into 70%. 1,40,000. So how much is the total value of liability? 1,77,500. Now can you net it off and tell me how much will be the cost of acquisition? 12,50,625 will be the cost of acquisition and you cannot claim the benefit of indexation. So 29,72,000 is the net sale consideration. 12,50,000 is the cost of acquisition and how much will be the long-term capital gain? 17,21,375 will be the long-term capital gain. I hope it is clear. And let's move on. We have completed slum sale. Now, keep quiet and listen. There is another provision called as section 50C and section 51. These are the two sections that I'm planning to cover in capital gains. So these are the two sections that we have to claim in. We have to complete in capital gains. So let's complete that too. Okay. Listen, 50C is pretty simple. We can finish off 50C in 2 minutes. Okay. Keep quiet and listen. Online friends, I hope I'm audible. Okay. Voice break. Is there any problem with my voice? Online friends, please respond. Am I audible? Am I audible? Audible. Yes. Superb. So listen friends, what section 50C says, keep quiet. Imagine you are selling a land or a building or a land and building. You are selling what? Either a land or a building
or a land and building. And your stamp duty value is say 1 crore 15 lakh. How much is the stamp duty value of the land you are selling? 1 crore 15 lakh. Your actual consideration is say 1 crore. And how much is your actual consideration? How much is your actual consideration? 1 crore. Now imagine you are selling a land or a building or whatever it is for a value which is less than the stamp duty value. Income tax department will come and say not acceptable. If you are selling something for a value which is less than the stamp duty value shall be deemed to be the full value consideration. Are you all listening? If you are selling an asset for a value which is lesser than the stamp duty value, then department will come and say stamp duty value shall be deemed to be the full value consideration. Are you all with me? This is what is called as section 50C, and we will read the heading. And what is the heading? Special provision for full value consideration in certain cases. What is the first sentence? Asset being land or a building or both held as capital asset. If the stamp duty value should be more than 110% of actual consideration. In the example, how much was the actual consideration? In the example, how much was the actual consideration? 1 crore. How much is 110% of 1 crore? How much is 110% of 1 crore? 1 crore 10 lakh. And how much is your stamp duty value? 1 crore 15 lakh. Is the stamp duty value more than 110% of actual consideration? Yes. Stamp duty value is more than 110% of actual consideration. And hence, you have to say that stamp duty value shall be the full value consideration. Are you with me? Now, let me make a small change in the example. Say, instead of 1 crore 15 lakh, say it is 1 crore 9 lakh. Say stamp duty value is 1 crore 9 lakh. And now actual consideration is 1 crore. Now you tell me whether stamp duty value is more than 110% of actual consideration. No. Stamp duty value is more, but it is not more than 110% of actual consideration. Hence, in this case, you have to show only that actual consideration as the full value consideration. For section 50C to come into picture, SDV have to be more. And it have to be more than 110% of actual consideration. Then only 50C will be applicable. Otherwise, 50C will not be applicable. Are you with me? Are you with me? Then, stamp duty value shall be deemed to be the consideration. Now there is a note. If the stamp duty value does not exceed 110% of the consideration received or accruing, then such consideration shall be deemed to be the full value consideration. That means if it does not exceed 110, then the actual consideration itself will be the full value consideration for the purpose of computing capital gain. I hope that point is clear. Is that point clear? Is that point clear? Superb. Now friends, moving on with the next point under this particular section. Listen. Say for example, in 2023 April, say 15th April 2023, I've entered into an agreement to purchase an building. To purchase what? A building. Normally when you buy immobile property, there will be always a agreement initially. Alright. Thereafter, the registration happened on September 2023. On September 2023 only registration happened. Are you all listening? So, you entered an agreement to purchase a particular building on when? On 15th April 2023. But registration happened only on September 2023. You got registered or you registered that particular thing. That means the actual transaction happened in September 2023. Say actual consideration was 1 crore. Actual consideration was 1 crore. But stamp duty value as on date of agreement was say 1 crore 20 lakh. Stamp duty value as on date of agreement is how much? 1 crore 20 lakh. And stamp duty value as on date of transfer is say, or date of registration is say 1 crore 30 lakh. There is an increase in the stamp duty value. There is an increase in the stamp duty value. Now the question is, which stamp duty value do you have to take for the purpose of 50C? There are two stamp duty values. Which one you have to consider? Either the date of agreement or date of registration. date of agreement subjected to one condition. What is that condition? There should be an advance received by the seller from the buyer. The buyer have to pay an advance to the seller, and the mode of advance have to be either account pay check or account pay bank draft or or electronic clearance system or prescribed electronic modes. Listen, not other than cash. Right now it is account pay check, account pay bank draft, electronic clearance system or prescribed electronic mode. In any other mode, not acceptable. Are you with me? So that point what they are saying is, if there are two stamp duty values, one in date of agreement and one on date of registration, and on date of agreement if you have received a advance by way of either account pay check or account pay bank draft or ECS or prescribed electronic modes, then you can take the stamp duty value as on date of agreement. In all other cases, you have to take the stamp duty value as on date of registration. That means you are not receiving an advance or receiving an advance but in any other mode, you have to take the stamp duty value as on date of registration. The stamp duty value will only go up. It will never come down. It's just like rocket. Okay, it will only go up, will not come down. Are you with me? Are you with me? Government will not reduce the stamp duty value. Once fixed, it is fixed forever. Then they may increase the stamp duty value. So reverse situation will not come. And nobody will enter an agreement after the registration. Nobody will. Once registration is over, then everything is over. Then there is no need of any agreement. What is the purpose of agreement? We will just like booking. We will book that by giving an advance. Then we will say to the seller, you wait, let me arrange the money, because huge money is involved in purchasing building and land. So normally date of agreement will be the first, thereafter date of registration will come. Are you with me? Are you with me? Yes. This is what the department say. Yes. Sir, we have a stamp duty value that is 1.1 crore and consideration 1 crore, the same as treated as 50C. No. That is stamp duty value as on 1st April 2001. This is stamp duty value as on date of sale. Ragul, both are different. Stamp duty value will always vary, okay? Stamp duty value will always vary. That is different, this is different. That is for the purpose of cost of acquisition, this is for the purpose of full value consideration. Yes. Are you all with me? Are you all with me? Stamp duty value goes up, then people goes to up. You are saying people will die? That's what you are saying? Yeah. So listen, coming back to the point, whether people go up or down, you have to qualify in September. That's it. Okay. Whatever happened, left or right, we will say east or west, you are the best, like that. East or west, you have to qualify in September, that's it. Okay, you don't have any other choice. Don't even think about anything else. There should be only one thing in your mind, qualify. And there is a thing is that, there is another magic will happen. If you think every time about qualifying your exam, you will automatically study. Okay, if you study like that, you will automatically qualify. Trust me on this. Trust me on this. You think about studies qualifying only, automatically that pressure will come. Automatically you yourself will study. You don't require any motivation. Are you with me? This external motivation only will have an effect of 10 to 20 minutes. Say I'm saying a motivating story, you will get, yes sir, today evening we'll rock. After half an hour, yes sir. It will be like that only. Whatever the motivating story I'm saying, that you will be like, at that time you will be fire. From today onwards, I'm about to study for 23.5 hours and all, you will say, in a day. But what will happen? Even for half an hour, you will not study. Very next time, and the motivation story, ella chumma fake story tha. There is no thing in that. You will give excuses to yourself. Okay. So the motivation have to come from inside. It should be self-motivation. For that one thing, dream about qualifying. Always don't dream about qualifying, okay? Just dreaming about qualifying. It's not like that. Always think about qualifying. Automatically that pressure will come. That will actually help you to sit more time in front of your book, okay? Yes. See you in final classes soon. Yes, that's what my expectation. Qualify your inter and let's catch up in final. Final is fun. Okay, inter is like I cannot go beyond certain extent in inter, but final it is fun because we can mix up practical things. Okay, inter if I mix up practical things, then topic will never get over, and it is unnecessary also. Inter na chumma ഒന്നുമേ ഇല്ല അതിൽ. Final, when it comes to final, definitely there are a lot of things. Income tax will become more interesting as well as more dry. Yes, yes, yes. For people who don't like income tax, final will be like very dry. People who have that interest in income tax, final will be like super interesting because our syllabus is that superb. And the questions we have, you saw my final video. I studied from my final video. For CMA Inter, yes, yes. She already have, because that have a kind of, you can mix up a lot of things and will be like one paragraph we will be interpreting in different ways. So that is fun. How to maintain consistency? Very simple. See, I can give you one tip to maintain consistency, okay? See, whenever you sit and study, take one piece of paper, okay? Take one piece of paper and you always try to write the type. Say for example tomorrow morning you wake up at 6 o'clock, okay? 6:30 you started your studies, okay? 6:30 you write the starting time. Then say 8:30 you are having your breakfast, so 2 hours. You need to write down 2 hours, and during that time, never touch your mobile phone. That is rule number 1. Never touch your mobile phone when you are started. 6:30 you go, sit on your table, take mobile phone, surf for 5 to 10 minutes. Then you put your mobile phone away and start that time, 6:40. 10 minutes mobile phone you have used, 6:40 you write. Then at 8:40 you have to set a target, 2 hours. After 2 hours, maybe after 1 hour or 1.5 hours, you will get tired and you will feel hungry. Maybe 1.5 hours, you write that 1.5 hours. Do that, and during the year, at the night or in the evening, you check how many hours you have studied. Interesting factor will be, it will be either 5 or less than 5. Then you will have that pressure, you will feel that pressure because I'm not studying enough. You may be sitting, but you are not studying. You may be sitting in front of the table. Your time will be like 6 o'clock, I'll sit on the table. You will sit and half an hour you will use mobile phone. And after the end of the day, you will say, from morning 6 o'clock onwards, I'm studying. Oh, you pavam me. I need some rest. You will think like that. No, don't do that. So whenever you are writing the time, whenever you have written that start time, keep away from your mobile phone. So you will understand that you will realize that you are not studying for at least 5 hours a day. I'm talking about a full free day. Are you with me? Second day automatically you will feel like I have to sit more. You get that. Once you get that momentum, then it will be with you. See, our brain have a problem. It's totally addicted to the habits. Our brain is totally addicted to habits. Let me give you one example. How many of you normally have a bed coffee? How many of you normally have a bed coffee? Nobody. Okay, forget about that. How many of you normally brush before your bed? How many of you normally have a brush before your bed? Okay, few are there. How many of you brush in the morning? Day. Okay, hands down. One day, tomorrow, you do one thing. Without brushing, you go out. What will happen? Tomorrow, without brushing, you go out. What will happen? You will feel like something is sticking on to your teeth. You will feel totally, you will not feel that confidence to talk. Yes or no? You will do like this. Yes or no? You will feel like some stain is there in your teeth. You will feel that you will not feel that confidence. Are you with me? Are you with me? Every time you will get irritated. Are you all here? See, if you have the habit of having coffee, every day if you are having a coffee at a particular time, one day you skip that, what will happen? You will feel a headache. Headache will come. I should have that coffee. Today I missed my coffee, so it's a bad day for me. These kinds of thoughts will come because the brain will give us stimulus. I didn't get coffee. Hello. And every day if you are brushing your teeth, the brain will say, hello, you haven't brushed your teeth. Okay, it's full of germs. Your teeth is full of germs and stains. Okay, be careful. Don't talk to people. You smell bad. You don't even know what's that smell. Other people may feel that, but your brain will say, you are smelling bad. Whenever that thought comes, you will feel irritated. Are you with me? Like that, all of a sudden, you go in front of your book, sit, try to study, your brain will say, hello, what is this? இதெல்லாம் எனக்கு பழக்கமே இல்லை. யூ ஆர் ஃபோர்சிங் மீ டு ஸ்டடியா? டே இந்தியன் 3 வந்திருக்கு. ஓகே லெட்ஸ் கோ அண்ட் வாட்ச் இந்தியன் 3. டே வந்து ரீல் வந்திருக்கு. Instagram there is a new reel. Go check it. Take your WhatsApp and send some messages. The signals will come. And you will have a headache. You will not be able to sit. You will feel like, oh, I'm not able to sit. Are you with me? Sit forcefully at that time. Don't hear this. Sit forcefully. During that day, most of the people will give an excuse that I'm not productive that day. That is the excuse. It's called as escapism. I'm not productive that day. Anyways, even if I sit or not, I'm not studying. So let's enjoy that day. We'll study from tomorrow onwards. Don't do that. It's not productive. It will not be productive, but you have to sit because you're training your brain. There's a concept called train your brain. There's a book called Transactional Analysis. It gives an overview of the analysis of the human brain. Okay, our brain have these kinds of problems. If it is not addicted, you have to sit and make him understand that for the next 2 months, you will be like this. You have to sit. For one day, you will not be able to. You will feel that tiredness. You will get bored. It will be like you will get this kind of, what do you say, you'll go mad, headache will come, but forcefully sit. Next day also forcefully sit. Third day onwards, you will get that momentum. Third day or fourth day onwards, you will get that momentum. Once you are in that momentum, never go back. Don't watch movies in between. Don't go for parties and all. Why? Because once your brain gets free again, because you don't have that much time in between. You can take small breaks. You can just go out, have some food, have some coffee, talk to your friends, coming back. Don't watch movies because that movie have hangover effect. That movie will have a hangover effect. The very next day you go, sit in front of your book, that movie song will come. Say you have watched the Nayanthara movie, then very next day if you open DT will not come, Nayanthara only will come. Are you with me? So once you got that momentum, never go back. This will definitely give you a better consistency. If you consistently study, definitely you will get result. Are you all here? I hope I have addressed your concern. Rangan Cheta Maso, you calling me Rangan Cheta na? Okay. I'll cut you, okay. Yeah. But didn't study, brain didn't said, sir, tell to use phone. That's the problem. Okay. Got September 5. Day. Got means Vijay movie. Vijay will be there only, okay. Vijay will be there only. After September 20th also, God will be there in the theaters. Subjected to condition, okay. Yes. Any limit for advance, sir? No limit for advance. Irrespective of the amount of advance, this provision will be applicable. So let's come back to the next provision under... Let's come back to the next provision under section 51, that is advance money received and forfeited. Please listen. Say for example, I have a property. I have what? A property. Are you all listening? Yes, keep quiet and listen. Say, I have a property. I've told that I'll sell that property, okay. I told to the people that, or I told to the public that I'm ready to sell my property, and one buyer came to me and he has given me an advance. But due to some events, that sale didn't happen. And I forfeited the advance. What do you mean by forfeiting advance? The buyer have given me an advance. In our agreement, I have clearly written that if this transaction is not completing, I have no plans to give you this advance back. So I can legally forfeit that particular advance. Are you with me? If I am forfeiting an advance, then you tell me what to do. What is the treatment in income tax if you are forfeiting an advance? So what department say? You need to check the date of forfeiture. You need to check what? Check the date of forfeiture. The treatment of advance money forfeited on or after 1st April 2014. That simply means if you are forfeiting an advance which is received in relation to transfer of an immobile property and the date of forfeiture is on or after 1st April 2014, then what to do? Such sum shall be chargeable to income tax under the head IFOS under section 56 subsection 2 clause number 9. Very simple. Today I have received an advance and I forfeited that advance. You tell me what to do. Today means 24-25. In the year 24-25, that forfeited amount have to be a income taxable under IFOS. Oh, yes. Are you with me? Because this provision came to the income tax with effect from 1st April 2014. Now, I know that you have a question. What is that question? What if the forfeiture is before 1st April 2014? Let's understand what is the treatment if there is a forfeiture before 1st April 2014. You tell me what's the treatment? Such advance shall be deducted from the cost of acquisition on subsequent transfer of asset. If the forfeiture happens before 1st April 2014, you have to adjust that particular advance with the cost of acquisition of that asset. I'll give you an example, okay? Listen. I have purchased an asset on say 1st April 2001, say for 10 lakh, and forfeited an advance on 2010-2011, that is rupees 1 lakh. I received 1 lakh and forfeited that particular advance. Then in 2023-24, I sold the property for 50 lakhs. I sold that particular property for what value? 50 lakh. How do you compute the capital gain? How much is the full value consideration? That means the year of sale is 2023-24. And how much is the full value consideration? 50 lakhs. Full value consideration is 50 lakh. Forget about direct expenses, okay? We will jump into cost of acquisition. You tell me what is the original cost of acquisition? 10 lakhs is the original cost of acquisition, but there is a forfeiture of advance, and that forfeiture is before 1st April 2014. So what do you need to do? You need to adjust that forfeited advance with the cost of acquisition whenever you are selling that particular asset. Are you with me? You need to adjust that forfeited advance with the cost of acquisition whenever you are selling that particular asset. So that simply means how much is the advance amount? That is rupees 1 lakh. You need to adjust this 1 lakh and your cost of acquisition will be 9 lakh. Only this 9 lakh is subjected to indexation. Even though forfeiture happened in 2010-11, you have to adjust that forfeiture value or forfeiture advance with the original cost of acquisition. Only the remaining value have to be indexed from 2001-2002. Are you with me? So how much is 9 lakh into 348 divided by 100? Come again? 31 lakh 32,000. So that will be the cost of acquisition. And how much will be the taxable long-term capital gain? 18 lakh 68,000 shall be the taxable long-term capital gain. Are you all with me? Are you all with me? This is the treatment of forfeited advance if the forfeiture is before 1st April 2014. But there is a problem in this. What is the problem? Say for example, have you understood this example? Yes, have you understood this example? Yes, now, listen. Say, Mr. Father is there. Mr. Father purchased this asset in 2001 for 10 lakh. And there is a forfeiture in 2010-11 by Mr. Father. And in 2018, say in the financial year 2018-19, Father transferred this property to son. Father transferred this property to who? Son. Now it is son who sold that particular property outside. Now it is the son who son is the one who sold that particular property outside. So you have to compute the capital gain in the hands of son. Yes or no? Now you tell me full value consideration will be 50 lakh. Now you tell me, is the son have forfeited any advance? The son haven't forfeited any advance. Only his predecessor forfeited that advance. Yes or no? For that, son is not required to adjust anything. Because in the case of son, when you compute the cost of acquisition, your cost of acquisition will be the 10 lakh itself. Are you with me? If the advance is forfeited by the predecessor, it is not adjusted with the cost of acquisition of successor. So it's actually a loophole. Because if the predecessor forfeits that particular advance, he can transfer that asset in the name of son and he can make that asset sell by transferring it in the name of his son. That's why on 1st April 2014, they have introduced the new law. Whenever there is a forfeiture, you tax that under IFOS in the year of forfeiture itself. Have you understood? Have you understood what I said? So this have to be there because in examination they may test any of this, okay? They may test any of this. So the treatment is very simple. You check the date of forfeiture. If it is before 1st April 2014, then what to do? What to do? Advance have to be adjusted with the cost of acquisition. If the forfeiture is after 1st April 2014, then what to do? The year of forfeiture itself, you have to tax it under IFOS. That's it. Moving on with the next one. Where were we? We were discussing capital gains. Now we have the rate chart, and now one more thing is there. There are certain exemptions for capital gains. Yeah. Come again? Yes. Because other cases that will be a proper transfer by the father. If a father is selling outside, then father is a transferor. If he is gifting, he is not a transferor. If he is selling outside, the father will become a transferor and he have to compute the capital gain. While computing capital gain, it's the father only have forfeited that advance. So you have to adjust it with the cost of acquisition. Got it? Come again? Yeah. So listen friends, in capital gain, there are a few more topics like 54, 54B, 54D, 54F, then 54EC. Okay, so listen, 54 is actually, I'll tell what exactly is this. You have to study this, okay? I'm not covering this in detail. I will say what is what. Are you all with me? Are you all with me? In case of free gift, okay, 1 second. In case of free or gift, how to treat? Gift is not treated as a taxable transfer if it is between relatives. Other gifts are taxable under IFOS, that we will study next. Okay. If the gifts are, if there is a gift between relatives, then it is not subjected to any taxes. It's not regarded as a transfer as well. If you are gifting something to someone else, a third party or something, that will be there are certain impact under IFOS that we will study under IFOS, okay? Don't worry. So listen friends, there are certain exemptions. So please keep quiet. There are certain exemptions that we have to study. So please listen and please don't talk. 54, what exactly department says? Say you have land or say you have a house property. Say you have what? A house property. You are selling that particular house property. You are selling that particular house property and you are buying a new house property. Are you all with me? You have a house property and you are selling that particular house property and you are buying a new house property. If you are doing this, when you are selling a house property, you have to compute the long-term capital gain. You can claim an exemption from the long-term capital gain if you buy a new house property. That means you sell a property and buy a property, you will get an exemption under section 54. I'm not covering it in detail, but you have to study it in your exams. Are you with me? What is 54B? You have a urban agriculture land. You have what? An urban agriculture land. And you are selling an urban agriculture land and buying urban or rural agriculture land. You will get an exemption under 54B. What is 54D? You have an industrial undertaking. It has been compulsorily acquired by the government. You have an industrial undertaking and compulsorily acquired by the government. And you are making use of that compensation to buy another industrial and not another industrial undertaking. You are making use of that compensation to buy another land or building to continue your industrial undertaking. Are you with me? Say KS Academy's buildings are taken over by the state government for constructing a flyover. So the state government have to pay a compensation to the KS Academy. KS Academy is making use of that compensation to purchase another building to continue their academy. That amount invested in the another building is allowed as a exemption. Then what is 54F? You are selling some gold and buying a house property. From the capital gain on account of sales of gold, if you invest that in a house property, you will get an exemption under 54F. And what is 54EC? You are selling either land or a building or a land and building. And the long-term capital gain you have invested in 5-year NHAI or 5-year RECL or 5-year notified bond, you will get an exemption up to 50 lakh. This you have to study. I've just summarized it. Are you with me? because for examination this is actually required, but because explaining this in detail itself will take at least 2-3 hours. I'm not investing that much time because we have to finish IFRS and 115 BAC is pending, and I want to make you solve a lengthy question which covers all the heads. Are you with me? All right.
To purchase recorded lectures and textbooks, visit our website www.cajoskorean.com.